pushing back on any changes when it comes to Medicaid, as well as how quickly they're going to roll back some of those clean energy tax credits under the IRA. At the end of the day, we're expecting White House officials to really start ramping up the pressure on lawmakers to ultimately come to a deal, because they are saying that they need to see this done by July 4th, because this is so pivotal to the Trump administration's ultimate economic agenda. At the end of the day, we do know, though, that the harder deadline is going to be what that X date is. Treasury Secretary Scott Bessent didn't give an updated or an exact date. Those previously said that could fall sometime in August, which perhaps would give lawmakers a little bit more buffer room. But he did go on in that interview, Lisa, to allude to the X date as a negotiating tactic, saying that they are keeping that sort of in their pocket as a way to motivate lawmakers forward on that bill.
Tyler, what are the biggest sticking points that senators have in this bill that was brought to them by the House?
What are some of the biggest sticking points? Well, definitely. We have to see how it shakes out, particularly on those spending cuts, and then also that I mentioned, but also what happens with the tax cut priorities here going forward. One of the biggest sweeteners in getting that House bill over the finish line was lifting the SALT cap to $40,000. And we know, as you well know, there aren't really any senators that are advocating for that to be ultimately included. And we have to keep in mind it needs to ultimately pass both chambers here. So could that be on the chopping block in a meaningful way? House Speaker Mike Johnson has made it clear that he has sent the message to Leader John Thune that he wants to see that ultimately in the bill. And then, Amory, I would also watch what ends up happening to some of the temporary tax cuts. We know that leadership has signaled that they want to see some of those made permanent, including those priorities from the White House, including no taxes on tips and overtime pay. Also, some of those business incentives, like to build factories in the U.S., could those perhaps be made extended or more permanent? And what would that mean to these conversations about ultimately adding to deficit spending?
Tyler, before you go, have they hauled in a huge wall-to-wall Bloomberg terminal with bond yields on it, with the WB page, the World Bond page, to really just give a good backdrop to these discussions?
Not yet, but I did tell multiple lawmakers on Capitol Hill when the House was debating this that you sent me, and that I was asking them if they were paying attention to the bond market or not. And I heard from multiple that they actually were. But at the end of the day, they ended up going behind this bill because they need to get the incentives ultimately through. That is one of the biggest issues here with doing this as one big, beautiful bill. There's a lot of priorities on the table, and it appeared that front-loading the tax cuts really was the message from the White House that they wanted to see done.
And maybe the 10-year yield is not one of them. Bloomberg's Tyler Kendall, thank you so much. Sarah Hunt of Alpine Saxon Woods is still with us. Of course, I am being somewhat tongue-in-cheek because Matt Hornbach was saying, stop giving that to me. Honestly, this isn't about the deficit. This is about other issues, and people have been crying about this forever. Do you agree with that, or do you think that this time really is different?
I think it goes back to the dollar still being the reserve currency and the discussions around whether or not that's capable of staying and everything else, and just not having, it's another not having an alternative. It's another Tina moment, right? Yes, you can have some bond bundle. Yes, you can see interest rates go higher a little bit, but at the same time, where else are you going to go when you need that kind of depth and liquidity besides the U.S. markets? It doesn't mean that we can't have dislocations. I just don't know that it is as big of a threat as it is in other places where the markets are smaller and it's easier for people to move things around.
Well, with this idea of what causes another major rupture, what is the canary in the coal mine? Jamie Dimon has been very vocal for some time that it will be the bond market, that its cracks are coming in the bond market, be it 6 months or 6 years from now. Is that what leads us into the next shaky period for markets? Is it the bond market that we should be concerned about?
Well, generally speaking, it's usually credit that leads you into a problem. Is it going to be government credit? That's the harder question to answer. And I think right now there are a lot of questions about all sorts of credit, but at the same time, there's still a lot of money chasing those dollars and looking for yield. So I don't know that it's as much of an immediate problem as it is a consistent thing that needs to be addressed, and whether or not it can be addressed. You know, Scott Bessent wants to do it over a longer period of time, over a shorter period of time. It's going to need to be addressed at some point, and it's good to be discussing it, but whether or not that is what causes the dislocation, I'm not so sure.
You made a very good point earlier, which is the fact that historically speaking, the dollar's not even that low.
Well, and this is what it goes back to, you know, there's all those horrible cliches like the worst dirty shirt in the laundry and all this sort of the best of the worst, right? So currencies are a relative game against one another. So then you have to find something that you say, okay, the prospects are much better there, therefore, or the rates are much higher there, therefore that currency is something I want. Chase, you're back to the dollar and the U.S. economy being so important globally that it's difficult to separate yourself from that. On the margin, you can move money around, and you can certainly, and people have in the last 6 months or so, started shifting shifting to other markets, but at the same time, you still have a bigger growth engine in the U.S. than you have in most of the other parts of the world, and that's difficult to ignore.
Well, even so, Sarah, let's say you're a UK investor in the US. You're still looking at losses for the year because of what the dollar has done if you're not hedged. In a totality of a view where the dollar is weakening and that is the trend, does it make investors more likely to sit locally? Does it just impact the flows of where dollars are going, especially in equity markets globally?
I think it definitely impacts your next choices, so the new flows as opposed to the older flows. But generally speaking, holding on to assets for a longer period of time has been what you want to do if you go back and look at even with the dislocations in equity markets. So yes, I think on the margin, again, it changes where people might put that next dollar and might put it for the next 3 to 6 months or 12 months. But from a longer term perspective, it's hard to see diversifying out of the U.S. on a permanent basis as something that's really going to end up being beneficial.
So there's a story on the Bloomberg terminal this morning. Buyers strike rocks U.S. long bond as double line PIMCO stay away. We were speaking with J.P. Morgan's Bob Michael about how the 30-year bond is a risk asset. We ask every single investor who comes on, are you buying the 30-year yield? Are you buying 30-year bonds right now? Do you think that that is an attractive purchase, and what would it take for you to like that? So I ask you that. What would it take for you to actually want to load up, back up the truck for 30-year treasuries?
I'm going to be just like everybody else, sadly, and say no, not right now on the 30-year.
Why? So why?
So that's a question of timing and yield right now, and I think that's the problem and that's the tension, because if the expectation is I need a higher yield to feel more comfortable with the 30-year, then that's a problem for the rest of the yield curve, possibly, and it's a problem for yields because they need to go higher. The price movements on the longer-term bonds are much more significant to your portfolio if you're not going to hold it to maturity. If you have something where I can match that duration to the yield on the 30-year, then there's no reason not to buy it as long as you're going to hold that. It's the volatility in between, and I think that's why people look at it as a risk asset, because when the price moves, it moves. I mean, when the yield moves, it moves more price-wise.
Just quickly before we let you go, how much does this really affect the 60-40 kind of concept for you?
Well, I think you finally have gotten that 60-40 concept back, and people are happy to hold fixed income, even with some of the volatility, just because they're getting some yield. And when you don't see them move in tandem, it does work better for the portfolio. That move in tandem is not, that correlation isn't always there, and I think people are still more comfortable holding fixed income. And again, for people, if you're holding those bonds to maturity, you can handle that volatility.
Sarah Hunt of Alpine Saxon Woods, thank you so much for being with us. Sarah Hunt there, not buying the 30-year. I gotta say, Danny, this is something that we talk about all the time. People say, oh yeah, the bond vigilantes, they're just crying. They always like to cry. But at the same time, they're not going into those long-term bonds either.
No one's buying it. And look, it might not be vigilantes causing big ruptures, but you could argue it is leading to higher yields when all things play out. And it's a problem when especially price-insensitive buyers aren't buying the long-term bond, when the Fed is loading off their balance sheet, when foreigners aren't looking at it. It just makes the asset class much more volatile.
And TD is saying that potentially as soon as August, we could have Treasury come out and say they're looking at shrinking the long end auctions, and then auctions will become a lot more important, Lisa.
Auctions have always been important, I would argue, and I will just say it's not just making American auctions great again, it is making Japanese auctions great again, because there are a slew of Japanese auctions this week that a lot of people are watching, because evidently all auctions matter. Coming up, Brandon Ferris of the Steel Manufacturers Association with President Trump set to hike steel and aluminum tariffs. That is a part of what's roiling markets. Also, the rising tensions between the U.S. and China, raising questions about whether this 90-day truce really can remain in place. This is Bloomberg Surveillance.
of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
It's early days yet, early hours, I should say, but maybe the sugar high from last month starting to fade just a touch as new tensions emerge between the U.S. and China, percolating over the weekend, escalating this morning. We can see that sending stocks lower pretty much across the board, although we're tracing some of the earlier losses, with NASDAQ futures leading the declines, down 0.5%. You can see S&P futures lower by about 0.4%. 2 hours away from the cash open. Here's your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Tesla shares. Those are falling nearly 1.6% here in the pre-market. I will say overall, we are seeing weakness among the Mag 7, but also hitting Tesla is this news, that new registrations for Teslas in France plunged 67% in May. They sold just over 720 vehicles in the country the entire month. That's Tesla's worst month there since 2022, while year-to-date Tesla sales in France are down nearly 50%. So the backlash against Elon Musk in Europe continuing. Next up, we have shares of Moderna. They are up nearly 3.5% here after U.S. regulators approved its new lower dose COVID-19 vaccine. And while it was approved for a narrower group of people, it is seen as a win under Health Secretary Robert F. Kennedy Jr., who we know has been a vocal vaccine critic. And last up, let's check on those steel and aluminum stocks. They are soaring here after President Trump said he will be doubling tariffs from 25 to 50% on steel and aluminum. All of this, of course, part of his push to bring manufacturing back to the U.S., and it's tied to the proposed partnership between Japan's Nippon Steel and U.S. Steel. He was in Pennsylvania touting it last Friday. So as a result, you are seeing Cleveland-Cliffs up 25% here and Century Aluminum up nearly 17%. Lisa?
Thank you so much, Yahira. We'll be talking about that a bit more in just a minute. On our radar this morning, a growing chorus of dollar skepticism. Morgan Stanley now expecting the dollar will tumble to COVID-era lows within the next year, anticipating the U.S. dollar index will fall 9% even after the losses that we've seen so far this year.
And it's troubling that they're pointing to the economy as being the reason behind this. Usually, if the U.S. economy is doing bad, everywhere else is doing worse. So you get to the other side of the U.S. dollar smile where it does well. This speaks to more of a structural shift. And this is something Terry Wiseman was talking about with me earlier, that we've had a destruction of the brand of the dollar. That all of a sudden, if you're a foreign investor, dollar assets are less attractive because of the weakness in the dollar. All of a sudden in your portfolio, the dollar isn't a ballast anymore. So it's almost this thing that tumbles, that gets worse, that snowballs because of the issues surrounding brand dollar. For every other reason, economic strength, other central banks are cutting, you'd assume that the dollar would be stronger at this point.
Well, also, Sarah Hunt brought up a great point. We're not where we are in terms of bearishness from historical perspective. So actually, maybe there is more room, to Matt's point, for the dollar to go lower. I do wonder, though, how much of this is really centered on where the administration gets when it comes to trade deals and trade negotiations, especially when the biggest economies in the world right now have a tit for tat when it comes to the trade war.
I do wonder how much of a self-fulfilling prophecy this becomes. The sort of death spiral of people who previously had bought U.S. assets unhedged because the dollar always was a strong currency and U.S. stocks always went up. And all of a sudden, you have wobbly U.S. stocks, wobbly U.S. bonds, a weaker U.S. dollar. And suddenly, how much does that cause, Danny, an entire rethink of asset allocation strategies around the world? Not that that's happening in wholesale, but even on the margins, it could potentially shift the calculus.
I was going to say, every now and then you get these little things popping up that become bigger things. Japanese life insurers have been a really good example of this. In Taiwan, the movements we saw with the Taiwanese dollar last month, really good examples of this. Again, it's only on the margin at this point, but maybe that's all it takes, just this slow bleed in a weaker dollar that does signal we're at a structural difference now.
In the meantime, of course, we're watching the tensions across the world around trade, U.S.-China trade tensions returning, with China's Ministry of Commerce accusing the U.S. of violating last month's Geneva trade deal, rebuking President Trump's claim that Beijing actually breached the deal. The dust-up threatening the prospect of a potential Trump-Xi phone call this week. The phone call that again goes back to, is someone waiting in some room, waiting for the phone to ring? What exactly was happening with this phone call?
Obviously, there's a lot of discussion between Washington and Beijing every day on the more aide staff level, maybe even on the cabinet secretary level, but not when it comes to President Trump and Xi Jinping. Even though Trump always kind of says we've talked, there has not been this formal phone call that we've been waiting on. But Kevin Hassett over the weekend says, quote, it's going to have a wonderful conversation, the U.S. president, about the trade negotiations this week with President Xi. That's his expectation. But now going into it, you have the Commerce Ministry coming out and really saying the United States is not living up to the demands from Geneva. And there's been a slow drip from this administration on a number of issues with China outside of trade. AI export controls, the China has a lot of issues with, jet engine materials, also even revoking Chinese student visas. So if they sit down for this call, how much is it really going to be about trade and how much is it going to be about everything else?
And there have been a lot of reports, Wall Street Journal, some of our reporting as well, suggesting that rare earth minerals was an issue too, something that would be really critical for the auto sector. But Cigna writing over the weekend that the timing for this is important, that Trump had just gotten questions as to whether he was chickening out. Trump just had a court of international trade decision go against him. So part of this is about for public consumption. It's about political appearances of standing strong and standing tough, not necessarily substantive policy changes.
Which is the reason why Signum didn't think this was a complete collapse of that truce, which was one of the more optimistic takes that I read over the weekend. President Trump, meanwhile, saying he will increase steel and aluminum tariffs to 50% starting Wednesday, adding that the move will protect American workers as Japan's Nippon Steel completes its takeover of U.S. Steel. Joining us now is Brandon Ferris of the Steel Manufacturers Association. Brandon, thank you so much for being with us. I just want to start with how the increase in steel and aluminum tariffs works hand in hand with this deal for some sort of participation with Nippon Steel taking a stake of U.S. Steel.
Absolutely. Well, thank you for having me today. And with the deal and with what President Trump announced on Friday of raising the tariffs to 50%, President Trump is responding to an industry that has suffered from surges of dirt cheap steel from foreign imports, particularly from China. And so as part of this, which was the largest investment in Pennsylvania history, these 50%, raising the tariffs to 50%, helps protect the American steel industry.
We've learned that the U.S. imports about 17% of its steel needs. This is according to Morgan Stanley. So do you think actually they really need this level of protection?
Yes. So even at 25%, and the U.S. International Trade Commission did a report on the 232 tariffs for steel. And what they found was that the price impacts were minimal, but what they really had a tremendous effect on was lowering the imports. 24% of imports were lowered when President Trump first instituted these tariffs in 2018. And so what we're still seeing is surges of steel into the U.S. China, over the last year, has dumped more than 100 million tons into the global market. That is more than we make in the U.S. in a year. So yes, we do believe that bumping up the number to 50% is going to be very helpful for our industry.
Construction companies, I'm sure you've seen, have warned that these levies are going to be increasing the cost of critical building materials. Do you have concern about the knock-on effects, what this 50% level means for the steel industry, for things like construction as well as the auto sector?
Absolutely. Anytime a tariff or anytime a trade knob is turned, you have to look at the ramifications. And when the International Trade Commission studied the 232 tariffs, what it found was for the downstream industries, 0.2% increase on their prices. So again, small increase on prices, but a major effect on taking those imports down.
The Trump administration, though, Trump himself had opposed this deal on the campaign trail. Are you happy about the Nippon-U.S. Steel deal?
We're looking forward to receiving more information. Again, what we look at is right now it is the #1 deal that has ever been announced in Pennsylvania. One of our other members, Nucor Steel, had just recently announced the largest investment in West Virginia history. So 2 out of 50 states, the largest investment in their history is steel. And so we like where this trend is heading.
Brandon, you mentioned the dumping of steel in U.S. markets coming from China. But let's be clear, this tariff will affect much more than China. It is a sledgehammer, and you've seen complaints, for example, from the EU, from the UK. Is this the right method to take for what is a very serious problem? Should there have been something more surgical coming from the administration?
We do believe that the 232 steel tariffs are surgical. And with this, yes, we do believe that it will help our industry. And the problem is not just China, it's global overcapacity. Lots of countries use cheap Chinese steel to replace their own and then send theirs onto the global market. And so this will help solve that issue.
So another concern, which again, the most recent moves, I'm sure you're hoping to concern, is something of just job stability and job security, and any guarantees that the administration and many people hope that Nippon Steel will guarantee. Brandon, how far can those guarantees go when it is an industry that is facing a lot of changes, that is facing changes when it comes to technology that change the workforce? How long can job security be guaranteed?
I can't speak for U.S. Steel, but what I can say for all of our members is that they have a more full order book than they've had in years. And what we're hearing is that we're hearing growth. Nearly every one of our members has announced growth, and this means more jobs, this means more revenue, this means better benefits for the economy. And so right now, what we're looking at, and what we've looked at since President Trump first instituted these tariffs in 2018, is a changed industry and a changed for the better. And that's what we're looking at when President Trump has recently made this change to 50% as well.
Brandon, are you worried about the U.S. losing customers if the U.S. angers essentially Canada and the European Union as some of its biggest exporters, or the people who actually buy some of this steel and aluminum, maybe sending them to look elsewhere if suddenly prices are that much more expensive?
What we can say is that most of the steel produced in the U.S. is used in the U.S. We do have some trade with Canada. We do have some trade with Mexico. And I know that there are going to be negotiations this year talking about that. But as far as protecting the domestic steel industry, which is vital for economic security, energy security, national security, we believe that moving the tariffs up to 50% was a very good move.
Brandon Ferris of the Steel Manufacturers Association, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Tensions are flaring between Russia and Ukraine. A Ukrainian drone attack destroyed more than 40 planes deep in Russia's territory, while Russia launched a drone and missile attack against Kyiv, killing at least 12 people. The attacks come as both countries prepare to send delegations to Turkey for a second round of peace talks today. Meanwhile, General Electric is passing on additional charges caused by President Trump's tariffs. The world's largest aircraft engine maker has about $500 million in residual cost challenges stemming from those tariffs. GE CEO Larry Culp is advocating for a return to a duty-free regime, making direct appeals to Trump and calling for the industry to speak with a unified voice. And Mission Impossible: The Final Reckoning is back on top in China. It posted the biggest opening for a U.S. film in the country this year, defying trade and geopolitical tensions between Washington and Beijing. Paramount Global's 8th installment in the action franchise earned more than $25 million in China, during the opening weekend. Tom Cruise has worldwide appeal. That's your Bloomberg Brief. Lisa?
Thank you so much, Ira. We'll move over. Tim Cook is the world's diplomat. Now it's Tom Cruise.
It's our cultural output, you know.
Maybe he's the one that could set up the Xi Jinping.
Yeah,
there you go.
He'll come in on a plane being like, let's go. Yeah, meanwhile, up next, mapping the rate cut path.
Assuming that the effective tariff rate settles close to my lower tariff scenario, I would be supporting what I called good news rate cuts later this year.
Maybe trying out for something. Aditya Bahave of Bank of America joins us coming up next. This is Bloomberg Surveillance.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Stocks coming off some of the earlier highs that we saw last month as people take a look at some of the tensions that are brewing between the U.S. and China, between the U.S. and Europe, between Republicans in Congress, as senators take up the deficit concerns with respect to the budget bill. We're looking at stocks that are off, although you can see bonds off too. And this is the correlation that a lot of people are getting concerned about. Although it's off some of the earlier lows, you can see yields rising across the board, the most at the long end of the yield curve with 30-year yields at 4.96%, up 3 basis points. Under surveillance this morning, mapping the rate cut path.
Assuming that the effective tariff rate settles close to my lower tariff scenario, that underlying inflation continues to make progress to our 2% goal, and that the labor market remains solid, I would be supporting what I called good news rate cuts later this year.
You heard that here first. Here's the latest. Federal Reserve Governor Christopher Waller sharing his expectations for interest rate cuts later this year, assuming inflation expectations remain anchored. Aditya Bahave of Bank of America writing, we now forecast 100 basis points of cuts next year. With low conviction, we pencil these cuts in for the second half of 2026. Aditya joins us now. And Aditya, thank you for that, because we're all humbly having low conviction about absolutely everything. So join the club. We're joining the club. I am curious what you make of some of those Chris Waller comments, where he seems to talk about good news rate cuts at a time when so many other Fed officials are saying we have no clue.
Thank you for having me. I think we have no clue is probably a more accurate representation of where we stand. The challenge here is that we had fairly favorable base effects on inflation for the first 4 months of the year, and so it isn't hugely surprising that we got down to about 2.5% on the core. The problem is over the next 8 months, the base effects are much less favorable, and so going down further is very unlikely, and in fact, it's more likely that as the tariffs set in, inflation will increase on a year-over-year basis.
Well, Chris Waller's argument in that was that you could look through that because we don't have the same tightness in the labor market, and the ability for employees to go to their employer and say, hey, inflation's going up, pay me more, is limited because they just want to hold on to their jobs at this point. Is that a fair characterization of where we are?
Okay, but if inflation's above target and you aren't sure whether you should look through the shock or not, and at the same time the labor market's holding up, why do you need to cut at all?
Yeah, fair enough.
So we don't think they're cutting this year, just to be clear.
So they're not cutting this year, but also another input into this, and this is something Michael Gapin at Morgan Stanley has talked about, this idea that we're going to have low immigration. And low immigration also means that the labor market's going to stay tight as employment growth slows. How much is that going to impact the outlook as this year progresses?
That's a more difficult one. I think it'll be very differentiated sector by sector. You're going to be seeing some sectors that are more dependent on immigration that could see wage pressures, such as construction, leisure and hospitality, agriculture. But in aggregate, if you're basically shrinking the population, you're reducing supply and demand. So it could also end up being a wash.
You said that if the labor market is holding up but inflation goes higher, why should the Fed do anything? Well, if inflation is going higher, shouldn't they be hiking?
Right, so that's a question that comes up every now and then. I think there's some ways away from hiking just because policy rates are already quite elevated, so they'll feel like they have some buffer. And again, they'd rather be late than wrong. This is a point that we've made, and I think it holds in both directions.
So you think this potentially will happen, even though you have a little bit of grain of salt on there, the second half of 2026. So do you think we'll have certainty on trade policy out of Washington by the second half of 2026?
Right, so the way we're thinking about the second half of 2026 is that by that point, inflation will start to, the tariff-driven inflation will start to roll off the year-over-year rate because of base effects. So with inflation below 3%, maybe a slightly looser labor market and different Fed leadership, you might end up getting rate cuts.
You said different Fed leadership. This is the question that we all really want to ask. Is Chris Waller just trying to get the job?
I'll let you decide that.
Okay, well, it seems like a lot of people would say yes. Is this the mainstream thought, or could this be the mainstream thought of the Federal Reserve? Do you think that this is the person to watch to see the direction for the Federal Reserve in 2026, Chris Waller?
So he seems to be, for now at least, a bit of an outlier on the committee. I think what you're hearing from Chair Powell and then others like Hammack and Williams is that the Fed is very patient right now. They just have no idea. Honestly, if you asked me, told me that the Fed should be preemptive, I would ask you, what is the Fed even trying to preempt right now? There's risks in both directions to trade policy. There's risks in both directions to fiscal policy. Let's just wait and see how it plays out. So Waller seems to have a pretty optimistic outlook that we're going to be able to do good news rate cuts by the end of this year, and that just seems a little bit too soon for us.
I'm sympathetic with this. The question, though, of wait and see for a data-dependent Fed really raises a question of what are you waiting for? Because the data is so incredibly messy, not only from a backward-looking, forward-looking, medium-working kind of point of view, but also just from a data collection point of view. You've had a real question about a lowering of response rates to some of the non-farm payrolls responses. Sentiment surveys are basically throw a dart at a dartboard. What do you do with the integrity of some of the data that we're getting?
So the good news about the payroll surveys is that at least by the time you get to the third reading, the response rate is pretty decent.
Yeah, when do you get that, 2030?
No, you get that by 2 months later, right?
Okay, but the point being.
Well, and then you have data that's unreliable. You have a Fed that's not moving. Aditya, the Fed is not in the driver's seat. It is a political economy, and you can even see it in what's happening with the currency market. Interest rate differentials are not making a difference. Is it a problem that the Fed is very passive right now, that they are very reactive? Is it a problem, especially if this economy heads in a worse direction?
I wouldn't characterize the Fed as passive. I think they've actually been pretty clear about their stance. They've pushed back against market pricing of rate cuts. They've made it very clear that they're concerned about inflation to a degree that was more than perhaps I would have expected. I mean, did you look at the minutes last week? It was really striking for me. They had this, when they were the discussion around balance of risks, they basically gave you this laundry list of concerns about why inflation might end up being sticky, and then just a sentence or two in the other direction, right, which is probably written by Chris Waller.
What is the danger? Just lay it out for us. If the FOMC starts to coalesce a Chris Waller type of policy outlook, what is the scenario? Why is that the wrong decision?
I think it's concerning in the sense that we just don't know what policy is going to get implemented, first. And then second, we don't know how it's going to affect the economy, right? Basically, what we're looking at is a negative supply shock from the tariffs being offset by potentially a positive demand shock from fiscal policy. That can give you the offset that you're looking for on the fiscal side. It can give you the offset that you're looking for on the output side. The problem is it can be additive on inflation, right? That's why they have to be very careful about the risks around inflation. And the other concern would be just that companies could raise their prices a little bit every year if they're concerned about losing market share, right? So you could get less inflation in the short run, but stickier inflation over time.
Just to give us a compass for how to look at the week ahead, what data point do you think is going to be most relevant? The JOLTS, the job openings, the non-farm payrolls report on Friday, or the Beige Book with all those quotes from specific regions telling you, I feel good, I feel terrible, I feel inflation, I feel layoffs?
I think it's the unemployment rate. You really want to watch the unemployment rate. I mean, typically the establishment survey is more reliable than the household survey, but as you mentioned earlier, we're in an environment where there's some movement around immigration policy, and that can affect labor supply. That can affect non-farm payrolls. So the unemployment rate, as long as that stays 4.2% or below, I think the Fed's going to be very comfortable sitting where they are.
Aditya Bahave of Bank of America, thank you so much. Great to see you. Always insightful. They might be comfortable staying where they are, but Anne-Marie, I bet someone in the White House is not.
They're definitely not. We saw a lot of Joe-boning from this president on wanting the Fed to cut interest rates, saying they're too high, calling Jay Powell way too late. Aditya's point on unemployment rates is also interesting, though. Bloomberg Intelligence is saying that they actually see it tick higher, 4.3%. You have to wonder, what's the line in the sand for the Fed when they see an unemployment rate, if it does tick higher?
It raises this question, though, and Denny, you say, you know, is this a passive Fed? And it's a question of how are you active at a moment where there are two-sided risks, and it's so hard to track one way or another with policy that's whack-a-mole.
Again, I think it's so important to look at the dollar in this context. Everything is telling you that the dollar should be stronger. The fact that you have a Bank of Canada and an ECB that are about to cut rates, the fact that the data has been holding up, that there still is some inflationary fear, and yet the dollar is weaker. It shows you that the Fed is not in the driver's seat, at least when it comes to currency. You can argue about their policy as a whole, but at least when it comes to the dollar, they are not in the driver's seat.
And it shows the huge dispersion on Wall Street, because you've got Bank of America saying no rate cuts this year, and you have Matt Hornbach of Morgan Stanley coming out with a pretty aggressive rate cutting schedule for next year, which they think does support bonds. Coming up next hour, Victoria Fernandez of Crossmark, Sadie Wudlitz of SW Retail Advisors, Stephen Stanley of Santander, and Winnie Caesar of Credit Sites as we count you down to the trading day. It starts in about, I don't know, an hour and a half, and we will be here. This is Bloomberg Surveillance.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
Yeah.
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
The magnitude and the severity of the trade restrictions are in doubt.
Many companies are on pause. They're waiting to see what's going to happen.
One thing that we have seen has been a willingness by the administration to extend deadlines related to tariffs.
What can happen from a policy standpoint can change any minute.
Data, the administration, trade is so volatile, but at this point, I think that we've really seen the worst case.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back with 90 minutes until the start of the trading day. Coming off the biggest monthly May return for the S&P 500 since 1990. Sounds nice and dramatic with a bit of a reality check this morning. Tensions between China and the U.S. rising back up, tempering the sugar high from last month's trade optimism. And Danny, earnings beats.
Yeah, a lot of earnings beats, and it feels like it's given us the confidence to say, okay, there's a lot of headline policy volatility. Let's ignore it. It seems like we're in this new regime where we assume that no policy, be it from the Fed or be it from the governor, will be followed through if it risks upsetting the market. You continue to see this market that climbs the wall of worry, but it's a narrative, and we have seen very acutely this year that narratives quickly change.
Which raises a question of what's reality and what's simply a narrative that's going to change by tomorrow. And that's why I ask you, Anne-Marie, how much we can really take away from the war of words that we see on the part of China as well as the U.S. saying there have been violations for this trade truce that goes into effect.
Well, I think you'd see an optimistic market if President Trump was to get on a call with Xi Jinping, which Kevin Hassett said he's waiting for this, quote, wonderful call that he expects to happen this week. I think right now what you see is both of these economies going into potential call with maximalist demands. But really, it comes down to the crux, I think, honestly, in AI and semiconductors. This administration has been very aggressive, not allowing some of these high advanced chips to go into China. At the same time, that is something China is not going to agree upon any trade agreement unless they can get some of that access.
As Kate Kalugowitz, a former trade rep for the first Trump administration, said, it really comes down to what is the ultimate goal, not just necessarily what are the deadlines that are going to be coming up at any given time. And this really comes not just with respect to trade, but also with respect to the budget. And I have to say, how much, you said this earlier, Danny, which I thought was really astute, this point about what are people focusing on any given day? It changes, your head on a swivel, whether it's trade discussions, whether it's earnings, or whether it's the budget and concerns about deficits.
Because you don't have any clarity on it. That's part of the problem. What do you sink your teeth into when it is changing every day, when the headlines are always changing? And you also can't sink it into the data. To your point, the data is extremely confusing. Maybe one area you can look at, which I think has been really interesting, is shipment volumes. Dropping from basically everywhere in the world to the U.S., despite the fact we've gotten pauses. We expected all of a sudden everyone would be shipping things in to get ahead of when that 30% tariff comes away from China. It hasn't happened, and that does speak to maybe corporate earnings will get worse. Maybe the one thing that was better is going to deteriorate, and maybe it's a bad signal for inflation as well.
Yeah, the new data, shipping and also electricity demand and other ways of measuring some of what seems to be increasingly unmeasurable. What we're seeing in markets is a bit of softness to start the month, to start the week, as people retrace some of the gains that we saw last month. The S&P lower by about 0.4%, NASDAQ down by about 0.5%. The Russell 2000 doing a bit better, about 0.2%. If you can see in the bond markets, what's getting some people worried is this positive correlation continuing, with yields continuing to grind higher, particularly on the long end, and continuing to grind higher throughout the morning. 30-year yields, that risk asset, 4.97%, clawing up toward that 5% level, up now 4 basis points. And this comes with that dollar weakness that we have continued to see throughout the month, throughout the year. The dollar weakening versus the euro the strongest versus the dollar going back to late April, as people take a look at the ramifications of some of these trade negotiations. Coming up this hour, Victoria Fernandez of Crossmark, as trade tensions weigh on markets, Stacey Widlitz of SW Retail Advisors on the state of the consumer, and Stephen Stanley of Santander, counting down to the May payrolls report that we're not sure what to do with just yet. We begin this hour with stocks lower following their best month since November of 2023. Victoria Fernandez of Crossmark writing, uncertainty remains even if economic data and technicals show the markets holding their own for now. We see additional choppiness in the coming quarters. Victoria joins us now for more. Victoria, join the club. Everyone's seeing choppiness because it's very hard to get a sense of what kind of direction to go in. I want to start with something that Danny was talking about earlier, which is that it's very hard to know which thing to focus on at any given time. Have we gone past earnings, and so now the focus just shifts squarely to trade, or does it shift to the deficit, or does it shift to something else completely?
Yeah, I wish I could give you a good answer on that, Lisa, but I'm just not really sure where the focus is going to be. As you guys mentioned earlier, it changes on a daily basis. So we're mostly through earnings, but there still are some good retail earnings that are going to be coming out this week. We've got some tech earnings coming out, but I think we're basically through that component. It's going to be, do expectations of earnings continue to get moved lower for the next couple of quarters? That's going to be the key component as it relates to earnings, and we've seen that happen. So that's going to be of concern, but obviously it's headlines that are going to be driving so much of this. The consumer is what people are watching. Credit spreads is what we're watching. Corporate profits is what we're watching. Those are all important, and they're all going to move on a daily basis depending on what it's hearing from trade and from the tax bill. So I think you have to take it all in stride, through a lens, however, of not being sure how much you can rely on the data, because how much of it is just due to the pull forward that we saw in March. That's another element you have to bake into your observations.
Which is one reason, Victoria, that a lot of people got a lot of confidence from earnings over the past couple of weeks. They came in significantly better than expected. Julian Emanuel calling it a boom in earnings and the consequence in the response in markets. That's real. You are seeing those profits. You are seeing companies that are still able to reaffirm some of their guidance. Does that give you confidence to be a little bit more bullish in risk assets than you were previously?
I think it gives us confidence in knowing that we will come through the choppiness that we're talking about over the next couple of quarters through all of the trade headlines, we will come through that hopefully with stronger economic elements on the other side of that. One of the most important things I think we're seeing out of earnings is that we can continue to have that CapEx number because profits remain strong. So you had revenues up, what, 6% or so this last quarter. When you look at CapEx, you've got a 2.5 times multiplier in regards to every dollar spent, and that's 13% of our GDP. So I think CapEx could be an element that continues to boost the economy, even with the churning that we anticipate.
Victoria, how surprising is that figure? Just because when all of the trade headlines started to kick off, the narrative was, and let's be honest, still is, that businesses are paralyzed by it, that they're not committing capital. They don't want to put things to work because they just don't know what type of environment they're going to be operating in. So are the CapEx figures we got and the expectations for them, not trying to be cute here, but are they real?
You know, I would have thought if you'd asked me that maybe 6 weeks ago, I would have been very concerned in regards to the earnings that were coming, to the guidance that we would get as it relates to CapEx, because of exactly the elements you said, because of the uncertainty and not knowing what to do going forward. But it seems like a lot of the businesses over this last earnings season have really kind of reiterated some of those CapEx spends. Obviously, some has been pulled back. But overall, we've still had some strength there. So I think if that continues, which it seems like it might if things stay status quo or slowly begin to improve on the tariff front and on the tax bill front, then I think you have the opportunity to see the markets move higher once we get through the headlines.
So American companies still want to spend, still want capital expenditures. Victoria, in Europe, it was much weaker what we got from their earnings in terms of capital expenditures. We are looking at an S&P that's up just 0.5% so far from the year. In Europe, stocks are up 7.5%. Looking at the company earnings, does that suggest that that balance needs to shift back to the U.S., that European outperformance maybe has gone as far as it can?
I think there's a few elements that kind of drive that story of shifting maybe back to the U.S. We had kind of broadened out some of our exposure to include Europe earlier in the year. But you had a lot of catalysts that drove that. You had the change to the debt, you had an increase in defense spending, and we saw the European markets really respond. And at that point, we thought it was time to take some money off the table and move back. And now you have increased concerns around inflation. We're seeing increased concerns, like you said, around corporate profits and what that means for CapEx. So I do think you could trim those positions, move them back into the U.S., into some of the sectors where you're seeing the momentum play. That's the most important factor right now in the market, is the momentum factor. Beta has kind of hit a little bit of a peak, and so I think that flows into this story of trimming those winners and maybe moving back into some of the areas that have better potential going forward.
How much of the international story will be told by what happens with some of the budget negotiations in Washington, D.C. right now?
Well, I think it all ties into what we're seeing as it relates to the dollar and into currencies, which you guys have been talking about this morning. So we've seen the dollar come down in concern around the deficit. You see that play out on a global basis. So you want to look at some of those countries that maybe have current accounts on the positive side of that. That should be supportive of their currencies versus the U.S. But obviously, it's a global trade economy right now. And so anything that happens on these fronts is going to affect everywhere. And we've seen it in yields rising. We talked about U.S. yields rising this morning. We've seen it in gilts and we've seen it in boons as well.
But how much of what's going on in Washington, D.C. when it comes to the fiscal package actually a headwind, or is it a tailwind? Because the fact of the matter is, this is just current policy as the crux of this bill.
Yeah, Anne-Marie, it's interesting because we always thought that from the very beginning of this new administration, we didn't think it was just like tariffs on their own. It was always kind of a more holistic plan of tariffs and deregulation and lower taxes and improving some of these elements for businesses. And so I think you have to look at what's going on in Washington through that lens and say, how does this help counteract some of the more downside elements that we're seeing from tariffs? It's a very important component. Congress is relying on some of the tariff revenue to offset some of the deficit costs. That's how they're able to go in and say that this is not going to add to the deficit. So it's something that we have to watch. It's all tied together, and hopefully we come out of this with some benefits from both sides.
Victoria Fernandez of Crossmark, thank you so much for being with us. Have a great week ahead, and we'll see you soon. Right now in markets, a little softer as people try to figure out where to focus next. Let's focus next on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Delta Airlines CEO Ed Bastian expects demand to tick up a bit in the second half following weakness in bookings in the U.S. market. The company is due to report earnings in early July and is navigating challenges such as tariffs and consumer hesitance, but Bastian believes the uncertainty will pass and a new stability will emerge. Meanwhile, raging fires in Western Canada forced thousands of people to evacuate from their homes. Meanwhile, oil producers in the region have evacuated workers, slowed or halted production, and have planned delays due to the intense fires. And former Fed Vice Chair Stanley Fischer has died. Fischer served as Vice Chairman of the Fed from 2014 to 2017, following 8 years as Governor of the Bank of Israel. He mentored a generation of policymakers at MIT, including Ben Bernanke, Mario Draghi, and Kazuo Ueda. Fischer was 81. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira, a giant in his field who is remembered by many. Up next, the morning calls, plus Stacey Waitlist of SW Retail Advisors on the state of the consumer. That's coming up next. This is Bloomberg Surveillance.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Clawing back some of the losses from earlier this morning, still a softer tone as people take a look at what's going on with the tit for tat between the U.S. and China, whether this truce could actually continue. You do see the NASDAQ leading the declines lower, 0.5 of a decline this morning. The Russell 2000 down actually a lot less, which is interesting given how much that had been the leader in terms of declines over the past few months. Time now for the morning calls. First up, Bank of America upgrading Boeing to buy, saying its aircrafts are the Trump administration's favorite trade deal tool. Next up, JP Morgan raising its price target on TJX to $145, the firm expecting a, quote, trifecta of profit and loss upside drivers. And finally, Wells Fargo raising its price target on Dollar Tree to $105, saying it expects a strong first quarter earnings report with accelerating share gain. Sticking with retail, Stacey Widlitz of SW Retail Advisors writing, consumers are in full-on value mode as inflation continues to be top of mind. Stacey joins us now. Stacey, thank you so much for being with us. We have been talking about how there is this end to the earnings season, but there are a couple of retailers still to come, including Dollar Tree and Dollar General. I'm just wondering what you're looking for in all of the retail earnings and what you've seen already that gives you an indication of what consumers are actually doing with the uncertainty that they're feeling and how they're putting it into action.
You know, we've seen this, as you just said, this hunt for value, and you've seen that in the winners, whether it's Costco or Walmart or TJX you just talked about, you know, traffic up, share gains. So that's where the consumer is going as the inflation headlines continue to hit them and as tariff fears continue to hit them. You know, I would also say that we've never seen a bigger gap between winners and losers when it comes to brands. And you've seen turnaround stories like Urban Outfitters that have been huge winners this season, and the consumer is absolutely shopping there. And then you've seen others like American Eagle that had huge missteps and took inventory write-downs. So the consumer's still out there, but they're definitely looking for the best deals. They're definitely worried about price increases. And in some cases, we're already seeing those come down the pipeline.
The inventory picture has been fascinating, Stacey. To your point, American Eagle, that write-down, also saying that they've been giving discounts. How difficult is this environment for retailers to figure out how much they need to be stocking up, especially as what tariffs ultimately look like is still unknown?
It is hugely complicated to figure this out because if you think about it, as tariff fears were coming in, retailers were saying, okay, we should front load. Let's get stuff in before that happens so we can get our, you know, maintain our margins at least for another few months before holiday. But then, of course, if you bring it in and it doesn't sell or you have a fashion miss like American Eagle, you have a write-down. You have too much inventory. And it's interesting because this really came at a time when inventories had been so clean for about 18 months. We were really at a point where you guys might have noticed when you're online looking for deals, there really haven't been as many deals over the last year, year and a half. So you've seen some spots, whether it's the Abercrombie brand, they've been promoting more to clear inventory when their brands really aren't hitting on all cylinders.
Is it your assumption then that it's going to be margin difficulty for the entirety of the industry, or is it just the likes of those of American Eagle that are having some issues with their strategy?
Well, I think again, there are definitely some winners that are still doing very well. But you know, take Gap for example. They actually came out and said, you know, our bottom line is going to be hurt by $100 million if you know the tariffs roll out the way we expect. So everybody's going to be under pressure. But you're seeing certain brands raise prices to offset it. And let's be honest, every year retailers do raise prices. You forget during COVID, prices went up significantly, whether it was Tapestry, that's Coach, or the luxury brands. And those guys are not promoting Ralph Lauren. They've gotten away with these price increases. They have not had to promote, and the consumer's still buying. So I think it's about what your product is. If it's in demand, you absolutely can get away with it and maintain your margins.
Stacey, over the weekend, the Treasury Secretary pushed back on this idea of what Walmart's saying and Best Buy's saying, and he said, well, look at what Home Depot and Amazon are saying. Is it a tale of two different tariff stories depending on what retailer you're at?
It is, and it also depends on where your stock is coming from. Are you heavy on China? Are you heavier Vietnam coming in? Are you local? You know, a company like Bath and Body Works, they're local. They produce locally in the United States, so they don't have to deal with the majority of the chaos that's going on. So that's a big, certainly a big swing factor.
The Treasury Secretary also talked about how he was reading the South China Morning Post, and they said that China, those factories are eating 65% of the tariffs, these Chinese producers. Is that accurate?
Well, what really happens, as we all know, is the consumer typically eats it. Or to some extent, the companies that have the power, like a Walmart can certainly go back to their vendors and say, here are the terms. You're going to share the pain with us so that we don't have to push the whole thing onto consumers. So it's a little price increase to the consumer. It's pushing back on vendors. But the majority of it we will see, on this side, certainly.
Stacey, are there going to be no back to school sales? I've got to be honest, we've been kind of debating this idea of sales because we've all kind of seen anecdotal sales and we're just wondering whether certain places can get sales and other places don't, whether there's certain types of products that are just not going to go on sales or whether your pencils are going to cost $5 each. I mean, do you have a sense of, are there particular areas that are just really becoming immune to any kind of cost cuts whatsoever because the margins are just so slim it's going to be impossible?
Absolutely. And I think, if you see any promotions back to school, it's going to be in those fashion names that perhaps don't hit it right with the consumer. And that's where your opportunities will be. Certainly in consumer electronics, you're not going to see any deals this year going into holiday or fewer deals. And of course, in footwear, we've seen a lot of volatility with Nike not doing well. Still, if you're out there and you're looking at apparel in the athletic space, the percentage of apparel on discount year over year, which we track at Nike and others, it's still way up. So there's still some deals to be had in the athletic space. But for basics, I think, like the last year, you're going to see slim pickings on the big discount side.
For those companies that don't hit it right, as you say, Stacey, what are they getting wrong? I mean, you look at a Gap who's tried to be really cool. They've done really interesting stuff, putting some of their fashion on red carpets. American Eagle, they've been trying to change. What are they getting wrong at this point?
So I think if you look at the turnarounds in terms of Urban Outfitters, which comped positive along with their Anthropologie brand that's been doing so well, they've been speaking to a younger customer. They've gotten their fashion correct. You look at a brand like Hollister that's been comping up 20%, again, like major turnaround in who they're speaking to, what their value fashion offering is. So they've been winning massive amounts of share. And at the same time, those ones have not been promoting. They're as full price selling. You're looking at the Gap. Their denim campaigns have just been a home run. Same thing at Old Navy. We've seen less promotions and less often 50% off sales all the time from those retailers. So it really starts with the product and then everything else falls into line in terms of the margins.
Stacey Widlitz of SW Retail Advisors, thank you so much for being with us. The point here that we're trying to get to is how much resilience does a consumer have, right? How much can a consumer really absorb some of these price increases? How resilient are they to some of the uncertainty that they feel, that they express in these surveys that people seem to be discounting? And how much can we use that as some sort of forward indicator as we have in the past? And Danny, I think that that's what people are having a hard time wrapping their head around because that's a confusing story too.
It is. I also thought it was really interesting, the airlines today, they were at IATA talking to Bloomberg's Guy Johnson saying demand is starting to come back. We are seeing more people travel. And they were kind of the canary in the coal mine. The first one to be saying that the consumer isn't spending more, they're pulling back on flights. They're starting to see it reemerge.
Well, we heard that last week from United. They're saying that they're seeing all these flights. People are really starting to come back in the travel space. One key thing when it comes to travel and these airlines is their biggest expense is fuel. And actually, airline fuel, jet fuel, has actually been coming down.
Which is the reason why they've been able to do this and maintain their margins. A real question going forward about what that demand will be. How much is domestic? How much is international at a time when potentially some of the international tourists are not coming back to the United States? Coming up, Stephen Stanley of Santander counting down to the May payrolls report as we try to understand how to even begin to look at the data that is coming up. This is Bloomberg Surveillance.
flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince.
Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Welcome back to Bloomberg Surveillance. We're looking at markets a little bit softer, about an hour away from the opening bell, as we take a look at some of the rising trade tensions between U.S. and China. A real question here going forward about whether this actually does imperil the truce. NASDAQ futures leading the way lower, 0.6%. In the bond market, you could see yields just creeping higher. Again, that positive correlation, and now near the session highs on 30-year bond yields of 4.97% up, almost 5 basis points at one point. And in the currency market, more of the same, and that is dollar weakness, euro strength. The euro touching near its highest levels going back to the end of April. 1 hour away from the cash open, here is your morning movers with Yahira Anand. Yahira.
Hi, Lisa. It's an M&A Monday, and this time it's in the pharma space. We are seeing Blueprint Medicines up 26.5% after Sanofi agreed to buy the U.S. biotech for $129 a share, all in cash. That represents a 27% premium to Blueprint's closing price on Friday, and this is a hefty price in a market where pharma M&A has been cautious. We haven't seen big pharma deals like this one all year, Lisa. Next up, we have the automakers. They are weaker this morning. Stellantis down 2.6%, while General Motors and Ford also weaker after President Trump pledged to double U.S. steel and aluminum tariffs to 50%. Bernstein analysts are saying the hike could raise car production costs by over $7,000 per vehicle, since metals, of course, make up a big chunk of auto manufacturing costs. And last up, we have sports betting companies DraftKings and Flutter, both lower after Illinois proposed an increase to its sports betting tax. Under this, operators would pay 25 cents per wager starting July 1st. But once they accept more than 20 million wagers, that tax will increase to 50 cents. And given both companies typically draw in about 150 million wagers a year, analysts say that bigger charge is likely to be triggered pretty quickly. Lisa?
Thank you so much, Yahira. Nothing like a buzzkill of an extra tax on your sports gamble. A busy week of economic data coming up ahead, culminating on Friday with that May non-farm payrolls report. Michael McKee, Bloomberg Economics and Policy Correspondent, joins us now for more. Mike, what are you watching for most closely?
Well, obviously, we're going to watch jobs. This is the first week of the month, and we get some of the biggest data points of the month during this week. So a lot going on, a lot for the markets to watch, a lot for the Fed to watch, although isn't really going to make much difference given that we still have no idea what's going to happen with tariffs. But as I mentioned, Friday's the big one with the jobs report. But today, we do get the ISM manufacturing numbers, and those will be of great interest to a lot of people looking at the new orders complex and whether or not export orders have cratered. And of course, we want to see what's happening with employment and with prices. Prices shot up in the last ISM number. Factory orders, an update on durable goods and non-durable goods. Jolts tomorrow. Jolt's much less important than it has been. And ADP, everybody trades on it. Lisa loves it. but it's not something that's going to get a lot of people all excited, I don't think. Trade balance on Thursday, we'll get a better look at what happened with the collapse in the trade balance, trade deficit that we saw last week. Jobless claims, everybody watching for first signs of problems. There are a few last words coming up this week from Fed officials. Not sure that they will make a whole lot of difference, given that everybody on the Fed continuously says, we don't know. But you've got Logan Goolsbee. Jay Powell speaking today, but it's really just a welcoming address to a conference at the Fed. Not going to be any monetary policy to it, as we understand it. Goolsbee, Cook, Logan on Tuesday. And then Saturday is, I think, when Steve Stanley and everybody else is going to be happy. Me too. We go into the Fed blackout period, and we won't have them to worry about for a couple of weeks.
Mike, thanks so much. And I will just say, everyone says they don't care about ADP, and then it comes out, and it fits with a narrative, and everyone trades on it. So we might see more of the same in just a minute. Stephen Stanley might be happy not to hear more Fed speak. We can ask him. He's sitting right here. Stephen Stanley of Santander joining us for the next segment. I'm just curious, with all of that data, Peter Scheer's words stand out to me, and I keep thinking about this over the weekend, where he wrote, sentiment surveys are on the cusp of shifting from confusing to irrelevant. He talks about, okay, that's sentiment surveys. Even the establishment surveys, responses have come down so much as to render them also questionable. How reliable is the data we're even looking at?
Well, I mean, it's the best we got. So we've got to go with what we have. I mean, I think, you know, the macro data is still pretty good in general. And I think the gap between the what people call the soft data and the hard data has been pretty dramatic over the last few months. But I mean, for example, I'm not surprised that we're seeing a big difference between consumer confidence and consumer spending. The correlation between those two has never been that great. So I think we're at a point now where there was some really bad soft data earlier in the year on the immediate aftermath of the tariff announcements, and we haven't really seen the follow through in the hard data. So we're at a critical juncture, right? The data for April were surprisingly unaffected by the tariffs, and now we're turning to the May data, and I think that's going to be critical.
So you think actually this is going to be really important data that does give us a tell of exactly what the read-through is to both the jobs market as well as just generally to sentiment. And we're not just talking about non-farm payrolls, but also the beige book and some other kind of tertiary indicators.
Well, I mean, if you look at the April data, right, employment number was fine, retail sales were fine, even the CPI was not anything different than normal, right? So there wasn't a tangible impact from the tariffs on the data in April, which is a little bit surprising, although, you know, in retrospect, we hear anecdotally that retailers were holding the line as long as they could. But, for example, Walmart said earlier in May that they weren't going to be able to hold the line much longer, right? So I would expect you're going to start to see some impact in May, and then the peak impact would probably come in June and July. And then what the Fed is looking for is then, you know, going over the other side again and hopefully getting back to normal. We'll see whether that happens, particularly for inflation.
There have been those making the argument that even putting beside the trade impact, there's already weakness. Neil Dutta has been making this argument. David Rosenberg has been making this argument that if you look at the lack of hiring and low jobs openings, all of that paints a picture of labor demand that looks something akin to 2020 levels. Are they right? Is a fine and benign headline level of employment masking over what's some real cracks in the labor market?
Yeah, I mean, I think what we're saying is just a diminishing churn in the labor market, right? Job openings have been falling steadily since they peaked, 3 years ago now, but layoffs have also been very low. And I think you would expect in a period of uncertainty that employers would be even more cautious in terms of hiring. But the big shoe that hasn't yet dropped is this increase in layoffs. So, you know, very closely watching various indicators of layoffs, most, you know, and the timeliest one is obviously the weekly jobless claims numbers.
What does that environment mean for employees' ability to turn to their employer and say, I'm worried about inflation, you need to pay me more?
It's not a great time. You know, if you're worried about potentially being laid off, you're not as likely to be bold to go into the office and demand a raise, right? So I think that uncertainty affects the economy in a variety of ways, and that's definitely one, is that it impinges on people's confidence about their job situation.
If the shoe to drop is going to be deterioration in the labor market, that could potentially happen this summer. So do you think the Fed needs to actually really start considering getting ahead of this and lowering rates?
I think the Fed is kind of deer in the headlights because, obviously a tariff increase is a shock that both hurts the economy and increases inflation. And I think at this point, they're not 100% sure which one they need to fight. As long as the economy's muddling through, I think they're going to focus on inflation. As I said, I think for me, the critical thing is at what point do the inflation numbers start to normalize again after we get that one-off burst of price increases.
So you think the bias for the Fed right now is actually on prices, not the job market?
Yeah, and I'm not, that's not to suggest I think the Fed is going to hike rates, but I think the Fed is holding steady at a time when they believe that policy is modestly restrictive. So if in that mode, if the economy were to weaken, ordinarily you would expect the Fed to begin cutting rates pretty promptly. And I think their hands are somewhat tied because of the inflation picture. If they get a reassurance that the inflation numbers are likely to come back down pretty quickly, then I think they have a much freer hand to ease if they need to.
How much do you believe that what we're hearing from Chris Waller is the mainstream of the Federal Reserve, given the fact that he's talking about the good kind of rate cuts possibly later this year?
Yeah, my sense is that he's a little bit outside of the mainstream at the moment. I have to say, I've been surprised at how little sentiment there has been along the lines of what Waller has been saying. Waller is basically continuing to press the case, the textbook argument that tariffs are a one-off increase in prices, not a persistent change in inflation. I thought we would hear that a lot more out of the Fed, and in fact, most Fed officials have been saying we're not willing to assume that. And you can understand after what happened in 2021, 2022, once burned, twice shy, that the Fed isn't willing to just make that assumption. But I have to say, I thought we'd hear more of what Waller's saying and less of what we're hearing from a lot of the other officials.
But when the Fed was making those assumptions, it's because of COVID. Tariffs in Trump 1.0 was a one price shock. It wasn't this pattern.
I would argue the big difference between then and now is the trillions of dollars of money that was injected into the system, right? I mean, in theory, a series of logistics problems like we had during COVID should have been a one-off. And the reason it wasn't is because at the same time that you had this going on the supply side, you also had this unprecedented injection of liquidity into the system. Obviously, we don't have that this time. So, I think the situation is different, but at the same time, if you're the Fed, it's hard to credibly argue, well, we said transitory a few years ago, and we see how that turned out. We're going to say transitory again. I think they've felt like they didn't really want to take that approach.
Steve, it's also hard not to argue that there's some sort of political bias, even maybe on the side of Waller, who maybe wants to be the next Fed chief, or on the side of everybody else who doesn't want to seem like they're endorsing Trump's strategies of tariffs. Is their politics seeping its way into a body that likes to insist that politics is not part of their decision?
Yeah, I think the Fed is absolutely doing their darndest to make sure it doesn't, but sometimes, as you say, sometimes even if it's unconscious, maybe you're resisting cutting rates because the president is demanding it, and you don't want to be seen as following that what they might view as a bit of a dictate. But I think that the Fed has been under some degree of political pressure, certainly for my entire career, and I think going back much longer than that. So the institution understands that and I think navigates that pretty well in general. I think Chairman Powell has been as deftly as possible trying to navigate what are unusually stormy waters, I guess we could say, in the last few months, and we'll see how that plays out.
Stephen Stanley of Santander, thank you so much for being with us. Really appreciate it.
My pleasure.
Stormy waters. I will have that in my head for the rest of the morning, and I'm sure some people would describe it a bit differently. It's been a pretty tumultuous time for Jerome Powell over the past couple of weeks.
Yeah, it feels more like he is on the deadliest catch and trying to fish crabs out as waves come and crash over him. I feel like that's the metaphor that I'm envisioning in my head.
Right now, let's get an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Russia and Ukraine are meeting in Turkey for peace talks. The talks come after a Ukrainian drone attack destroyed more than 40 planes deep in Russia's territory, and a Russia attack against Kyiv killed at least 12 people. Meanwhile, Morgan Stanley predicts in a year from now, the dollar will tumble to levels last seen during the pandemic. They see the U.S. dollar index falling about 9%. Strategists there also predict 10-year Treasury yields will reach 4% by the end of this year and decline further next year with 175 basis points in rate cuts from the Fed. And billionaire Elon Musk says he is not using ketamine, disputing a report by the New York Times. It reported on Friday that Musk had used drugs more heavily than previously known during Trump's presidential campaign and that he took ketamine often and used ecstasy and psychedelic mushrooms on occasion. Musk wrote on X, "I tried prescription ketamine a few years ago and said so on X, so this is not even news." That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. I have to say, he's got a great T-shirt game. The Doge Father, I'm telling you, like he always comes out with these sort of self-made T-shirts.
Right. I think for the Oval Office, though, potentially suit and tie might be more appropriate.
Yeah, here we go.
Plus a trucker hat, suit, tie, hat.
Of course, style police over here. Up next, setting you up for the next week, for the week ahead. Plus, Winnie Caesar of Credit Sites as the bond market looks for policy clarity. Good luck with that. This is Bloomberg Surveillance.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Counting you down to the opening bell. Right now, we're looking at futures that are just lower a touch as people try to parse through what we know, what we don't know about policy. What we don't know is whether this trade truce is going to stay, although some of the earlier weakness really coming back. NASDAQ futures down just 0.4%. We can see, counting you down to the opening bell, 10 a.m., we've got ISM manufacturing. Tuesday, durable goods and JOLTS, the job openings data. Wednesday, ADP employment data and ISM services. On Thursday, the trade balance and another round of jobless claims. Watch out for the continuing claims in particular. Plus, German Chancellor is meeting with Trump at the White House. And Friday, the big one, it's the pay non-farm payrolls report. Turning now to Capitol Hill, Treasury Secretary Scott Bessent saying the U.S. is never going to default as the deadline for increasing the federal debt ceiling approaches. Winnie Caesar of Credit Sites writing, we still think that 4.75% is a reasonable target for 10-year Treasury yields as we see increasing term premium fueled by higher deficits and evolving risk associated with the U.S. fiscal trajectory. We were looking for a potential bond vigilante. Maybe we just found one. Winnie joins us now for more. Winnie, we've heard so much about the bond vigilantes screaming a big scream, but not actually getting in a game and coming in to buy when they finally decide that there is going to be no change. Why is this time so different?
Well, I think this time is different because of the change in expectations around institutions. We have some fiscal policy on the table in terms of the extension of tax cuts and incremental tax cuts that I think a lot of people are looking at and a little bit skeptical about the corresponding growth that may come with it. We have a lot of skepticism around the trajectory of tariffs. Are these good? Are these bad? What is the ultimate goal for the U.S. and global economy? And then we also know that there is an awful lot of supply that needs to come for Treasury funding, especially if yields remain elevated. And while I don't think that we are going to see bond vigilantes really outright selling, just having some buyers strike is not particularly helpful for yields.
Well, it's not just U.S. supply, Winnie. This week on Tuesday and Thursday, we'll get 10 and 30-year auctions respectively in Japan, a 40-year gilt in the U.K. on Tuesday. Have these become big risk events for American markets as well?
I think that the move higher in yields really globally has become something that people should focus on much more closely. Now, we're not expecting auctions to fail or, a massive investor strike from any of these auctions, but looking at the clearing levels and also looking at kind of what central banks are saying about the trajectory of policy combined with what is the long end actually doing. Are we seeing these incredible steepening moves? That's always something to pay attention to overall.
As that happens, as we continue to see Treasury yields grind higher, does in turn credit spreads, do you expect them to continue to grind tighter too, Winnie?
We do not. So we have been expecting to see more credit spread volatility this year than last year, especially. That's not a heroic call given how benign the volatility environment was last year. But a few different factors are really supporting our view. First of all, if we see uncertainty around broader policy, both monetary and fiscal, that is not particularly helpful for corporates trying to make decisions around their capital spending and also forecasting. We're not seeing the type of massive consolidation and intentional releveraging that is usually correspondent with wider spreads. But we are seeing a pretty significant uptick in uncertainty. And we're at a little bit of an inflection point in terms of fundamentals. I would say that fundamental starting point right now is pretty good. We haven't seen a lot of that kind of bad or intentional releveraging behavior. But if we start to see some softening in growth expectations and top line revenue, while at the same time costs are just not coming down at a similar level, that can be really challenging from a profit margin perspective. And we also think will probably weigh on spreads as investors start to assess ratings trajectory and a potential default cycle rising a bit.
Winnie, how much does this have to do with actual credit fundamentals and how much does it just have to do with international flows and this question around whether so many Japanese and other life insurers are going to be coming to the U.S. credit markets for yield?
I think that the supply and demand dynamics, so the technical side of the equation, and fundamentals are always very linked. When you have a strong technical backdrop like we had last year, where there was just robust demand for corporate credit, for risk assets more broadly, that provided really great access to primary markets for a wide range of issuers, from investment grade all the way down to high yield and broadly syndicated loan, including some CCC stressed and kind of cuspier issuers. And when that type of liquidity starts to fade or outright reverse, you do start to run into more fundamental challenges overall. So I think that there is kind of a dual impact on both the technical and the fundamental side.
When it comes to where you think the 10-year yield is going, you say 4.75%. You think it's a reasonable target based on what's going on with the deficit and fiscal policy. But what about what's going on with trade? Because we have seen the bond market push back on all of the trade headlines. And right now we're going into a week we're a little bit uncertain where the United States stands with China.
Yes, it's yet another week of uncertainty, which just seems to be the name of the game in 2025. So we have never fully embraced kind of the hard landing recession scenario associated with trade. We do think that the administration is attempting to negotiate new trade policy. Now, there's a lot of question marks around what that means for relationships with countries like China and some of our more kind of friendly countries like within Europe and Canada, et cetera. But what we think is bond yields are probably going to stay a bit elevated, that the expectations around the fiscal side of things are probably going to matter a little bit more coming into the summer months as we have more understanding of what the Senate would like to include in the big, beautiful bill. And the convergence of all of those different factors are probably going to push long end yields higher, especially as we start to see a little bit more sticky inflation data, especially on the good side of things, come through the broader economic data, and the Fed continues to message its contentness to be on hold for the foreseeable future.
Winnie Caesar of Credit Sites, thank you so much for being with us as we look for who's going to buy those 30-year bonds, because right now not a lot of people want them, and we've been hearing these concerns about how much this is tied to the deficit. One of the highest profile people to raise a concern was Jamie Dimon, the head of JP Morgan, who said that the U.S. bond market will crack under the weight of the deficit, cautioning regulators, you are going to see a crack. I'm telling you this is going to happen, and you're going to panic. I'm not going to panic. We'll be fine. And this is a man who came out in an interview that was aired this morning saying that his retirement from the top post at JP Morgan is several years away, but the decision is up to the bank's directors. Danny, it's up to God and the board. I love what I do.
I kind of preferred it when he kept saying it was 5 years away. It's a little bit weird to be like, it's up to God and the board. I wonder how the board feels about that being the order of importance. They might think that they come before God. Yeah, it's a little bit morbid, I would say.
It sounds a little bit like a monarch, you know, when you're ordained by God, and that's when you think that that is the end to your reign. I will say it might be advantageous for Jamie Dimon to wait for potentially as an administration that he could join, because then he can defer capital gain taxes or any divestments required under the ethics rule if you're moving from the position he is in into government.
Well, in the meantime, it would be about non-farm payrolls, but it isn't about non-farm payrolls as much as all of these other headlines, because frankly, the economic data, Danny, has been such a question mark in terms of how to even understand it in the broader scheme of things.
Yes, but I go back to this thing of at what point do we just get headline fatigue? That every piece of data that comes in, you say, I can't trust it. That every headline that comes in from the Trump administration, you say, well, it's a negotiating stance, he'll change. That you just go back to earnings were really strong, so I'm gonna keep buying.
You pick out that one thing that you like and you keep going after it. Coming up tomorrow, Cameron Dawson of New Edge Wealth, Chris Harvey of Wells Fargo Securities, Marriott International Chief Executive Officer Tony Capuano about the demand for travel, and Tom Kennedy of JP Morgan Asset Management as we figure out what the new adventure is for the new day. This was Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%, and I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
All right, we are looking at futures down again on U.S.-China sentiment. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, trade tensions flare up yet again. China and the U.S. accuse each other of violating the recent agreement. Plus, another twist in Trump's tariff agenda. The president pledges to double tariffs on all steel and aluminum imports, and an M&A Monday. We kick off the week with two big pharma deals as companies battle for market share. Katie, this is your wheelhouse.
It is. And
one of your wheelhouses.
Let me tell you about these deals. We have Bristol Myers paying BioNTech $11 billion to license its next generation cancer drug. You also have Sanofi buying U.S.-based Blueprint Medicines in a $9 billion deal. Look at some of the numbers behind me. BioNTech up about 13%. Blueprint absolutely soaring right now. And then not in deal news, but in the health industry, we're also taking a look at Moderna winning FDA approval for a new COVID vaccine for a narrow group of people under new HHS leadership, but still approval nonetheless, and Moderna shares up a needed 3.7% pre-market.
Yes, so massively important work, pretty important work, and for a smaller slice of the people, it's
your opinion.
Aluminum and steel stocks are moving bigly after President Trump said he would double the tariffs on those metals to 50% from 25% in an effort to aid the Japanese Nippon Steel purchase of U.S. Steel shares. You can see, well, U.S. Steel itself already had the rally last week. Nucor up 12% and Cleveland-Cliffs gaining 27, Katie.
Which we will get to. But, Matt, as you mentioned at the top, you have U.S.-China tensions again, weighing on investor sentiment after President Donald Trump accused China of violating the latest trade deal. Now you have China, on the other hand, also accusing the U.S. of violating the trade agreement by introducing new chip restrictions and targeting Chinese student visas. Here's Treasury Secretary Scott Bessent over the weekend.
That when President Trump and Party Chairman Xi have a call, that this will be ironed out. So, but the fact that they are withholding some of the products that they agreed to release during our agreement, maybe it's a glitch in the Chinese system, maybe it's intentional. We'll see after the president speaks with party chairman.
Let's bring in Bloomberg Washington correspondent Tyler Kendall at the White House. And Tyler, we also heard advisor Kevin Hassett say that President Trump is going to speak with Xi Jinping this week. How solid does that prediction look?
Yeah, hey, Matt. Well, this recent escalation of tensions really does throw a wrench in it, although I can say I just caught up with the Deputy Treasury Secretary Michael Falkender here at the White House, who told me that eventually this is going to have to come to both leaders getting on the phone to talk about a way forward here, because we're starting to see some cracks in the agreement that was reached in Geneva, with both sides accusing each other of violating it. On one side, you have, of course, China saying in a new statement out from its Commerce Ministry this morning, really rebuking the White House when it comes to their concerns about AI chip controls, as well as plans to revoke Chinese student visas. But the other end of this, ahead of that, was the U.S. accusing China of basically slow-walking the export of critical and rare earth minerals. Falkender did add to me that they did have discussions over the weekend with Beijing about this to, as he called it, unlock these exports. We have to keep in mind, of course, these are critical minerals that are very important to these essential supply chains, as you all know, from the defense industry to autos to chips. Actually, in fact, Matt, China controls the production of about 30 out of 50 critical minerals to the U.S. That's considered to be just a huge number. And Bloomberg Economics says that as Beijing wields this weapon, even if it's not at maximum capacity, it still has such great power to inflict pain on the United States going forward.
And Tyler, when it comes to this potential call that it seems that the U.S. is asking for between President Donald Trump and President Xi Jinping of China, isn't this not what China wants to do? Wasn't one of the asks of the Chinese administration that they want a delegation from the U.S. to be handling the negotiations, not the two leaders necessarily talking to each other?
Right, exactly, Katie. This has long been one of those points for China. Our reporting, a few months ago was that they wanted a point person other than President Trump to lead these negotiations. It appears that they were able to get that with Treasury Secretary Scott Bessent, but then you have the top advisors to this White House saying that President Trump still will be directly involved in these negotiations. President Trump himself saying that he does want to ultimately get on the phone. We're going to have to see how this ends up shaking out here, because there are still a lot of different pressure points and issues as these tensions do escalate. And keep in mind, one of those deliverables that came from the Geneva Agreement was that they established a mechanism to keep talking with each other to try to prevent something like what we're currently see happening. These tensions escalate. So we're going to have to see if they can resolve this anytime soon.
All right, Bloomberg's Tyler Kendall, appreciate your reporting, joining us from D.C. And another decision from President Trump is having a major impact on steel stocks. The president said he would double tariffs on steel and aluminum to 50% from 25%. Here with more, I'm thrilled to say we have our commodities queen, Alex Steele. She's also co-host of The Close, coming in early for us. Alex, great to see you. It seems like there's a bit of a pair trade going on this morning, which is long steel stocks and maybe short some autos here.
Oh, and definitely short overseas stocks as well. You saw BMO Capital Markets downgrading Algoma Steel, its Canadian steel company. And the reason why is the U.S. imported, as of last year, 26.2 million metric tons of steel. That's a lot. Now, if you just sort of factor out broadly, maybe the U.S. produced around 20 million net tons. So there is a gap that needs to be filled. And guess what? A lot of that goes to from Brazil, Canada, Mexico, and South Korea, for example. And in any industry that clearly is going to use steel, Matt's industry, cars, my industry, oil, it is going to be hurt by this. Your input costs are going to rise.
Yeah, so President Trump doing this to protect U.S. steel as Nippon Steel buys it. Am I getting this correct? Because I can't get anyone to tell me a straight story.
We have no idea what Nippon Steel is doing. We have no idea what this golden deal is either. So we have no idea if it's an investment, if it's a buyout, and if the government's really going to have say in it. So that's number one. Number two is that it's not just necessarily about steel, for example. It's going to be about the other commodities, critical minerals and copper as well. So if the administration did this with steel and upped it to 50%, now the expectation among analysts with Citi is that we're going to see that with copper. We're going to see it with most minerals. And that's going to sort of across the board. Like, do you know how much steel and copper is used in a car? No, I mean, off the top of my head, no, but it's going to be a lot, right? So that's going to wind up hurting all of that. And domestic prices are going to have to rise a lot to offset those tariffs to make those tariffs overseas worth it to buy. So you're going to have a huge rise and a discrepancy all over the world between these two metal prices.
Alex Steele with the latest on steel. Great to get your reporting and your insight there. That is Bloomberg's Alex Steele. You can catch her on the close, but don't go anywhere because we're going to turn to pharma right now. Bristol Myers will pay BioNTech as much as $11.1 billion to license a next-generation cancer drug. For more, I'm pleased to say we're joined by Bloomberg health reporter Damien Garde. And Damien, it seems like cancer is one of the sole hot areas to do deals right now.
It does. In fact, I think that reflects both that the pace of new developments in cancer has been faster than many other disciplines in science, but also on the business side, that is just one of the safer places to invest for these pharmaceutical companies that are facing so many headwinds, but among them drug pricing challenges. And cancer medicines have generally been reimbursed and covered at a much higher rate than other clinical categories. I think that partially drives what we're seeing.
So a lot of these medicines seem to come from China. What's the treatment BNT 327, which was licensed from a Chinese company by BioNTech. Then they bought the Chinese company. Now Bristol Myers Squibb is going to use it. What's the story with the Chinese biotechs doing so well on cancer?
It's kind of fascinating. So as you mentioned, this medicine comes from China, and all of the medicines like it that have the similar target that this pursues to treat cancer have all originated in China. One that's partnered with an American biotech company, another that went to Merck, and another that was licensed by Pfizer. So this is an interesting kind of sea change in the United States' relationship with China in terms of new medicines. For years, it has been perceived as China is a place where you can go get kind of a Me Too molecule that works similarly to something developed in the West, but that might be cheaper by virtue of it coming from China. In this instance, China is leading the drive here. These medicines were invented in China, and there are not, by and large, American equivalents of them.
We have to talk about one of the other big news items coming out of the health industry today, and that is Sanofi. It's a French drug maker buying Blueprint, which is U.S.-based. And what stuck out to me was that you had the CEO of Sanofi, Paul Hudson, saying that they still retain a sizable capacity for further acquisitions. And that's after this deal, which is for at least $9.1 billion.
Yeah, I think part of the reverberations of this news is that things have not been going well in the biotech industry by and large. As I mentioned, the headwinds they face, not only out of Washington, but more broadly with macro stuff. So to see a deal like this, where a company is paid, it's not a huge premium, I think it's 27%, but still, a deal getting done of this magnitude in 2025 is good news for the entire biotech sector, which has been fairly beaten down, and M&A just really hasn't been there this year, despite the fact that with depressed valuations, you would assume that the likes of Sanofi or Bristol Myers would be out shopping, but we haven't seen that as much, and so this is definitely good news for sentiment.
Absolutely, and you can see Blueprint shares up 26% pre-market. I believe that deal price was about a 27% premium to Friday's close. So there you have it. Health reporter Damien Garde, great to see you. Let's take a quick check on these markets. Matt, it is notable that today will be the first trading day of the second half of the year. We said goodbye to a May where the S&P 500 rose 6.2%. We're on a little bit of a downdraft this morning, maybe as a result. You can see the S&P 500 down about 0.4%. Then you have the NASDAQ 100 down a little bit. The Russell 2000 pretty much unchanged at the moment.
We still watch that, huh?
We still
have
do.
the Russell 2000 up there, which is fascinating.
We have to keep an eye on these domestically focused small caps.
Yeah, so it is traditionally one of the slowest moving months, June, right? As Wall Street sort of decamps to the Hamptons.
We still look at seasonality.
Yeah, SEAG. Go.
Yeah.
On any index. It even works on the less significant indexes.
I'm just saying that because sell in May did not work.
No, it was a bad plan this time. Let's talk about, when we come back, new street high price target for Boeing. This is a story that Katie has been following for years. This iconic plane maker, thanks to its status as President Trump's trade lever, some analysts like it even more. This is Open Interest.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's get to high interest now. Look at what's making headlines around the world. Russia and Ukraine are resuming direct peace talks in Istanbul a day after Ukraine staged one of its boldest aerial attacks inside the Russian borders, which destroyed long-range bombers and other aircraft. The meeting marks only the second time the two sides have held public negotiations since the early days of the conflict. Prospects for peace, though, remain distant despite months of high-profile efforts from the Trump administration. The president has grown increasingly frustrated with the lack of progress. Zelensky says the talks have just ended. And Tesla sales have plunged 67% to an almost 3-year low in France. That's despite the company rolling out a redesigned version of its most popular vehicle, the Model Y. The news undercuts CEO Elon Musk's assertion that the car maker has recovered from its sales slump, at least in France. Last month, Musk told Bloomberg News the company had already turned around. And Delta CEO Ed Bastian says he's more confident about demand in the second half of the year after U.S. passengers cut back on travel spending in recent months. He spoke in an exclusive interview with Bloomberg in New Delhi over the weekend.
I think in the U.S. structure, lower ticket prices is part of the reason we're seeing lower prices as costs have come down. It's helping to insulate the fall off that we've seen from expectations on demand. Year over year, though, demand hasn't fallen. Demand's pretty flat, and I expect in the second half of the year, it hopefully will tick up a bit.
For more on aviation, we're joined now by Bloomberg's Benedict Camel, who leads our global aviation coverage. So Ed Bastian was speaking to Bloomberg, along with many other airline executives at the IATA AGM in New Delhi. And reading and listening to some of these comments, these executives seem pretty sanguine versus the earnings season that we got through a couple weeks ago, where you had airlines pulling their outlooks or giving different forecasts based on different scenarios. Did all that much change in the last 2 or 3 weeks?
Well, the only thing that might have changed by now is that people have started getting used to the situation that they're in, which is the sort of up and down, the in and out in terms of the tariffs. But tariffs, make no mistake, remain very much the top theme, and the fallout from tariffs at the IATA AGM. We spoke to Ed Bastian, we spoke to Larry Culp, the head of GE, and these are all companies that are feeling the effect. GE are feeling it in terms of the price of their products. They have to hand some of those additional costs onto their suppliers, onto airlines. But airlines like Delta from that we just heard from, or Virgin Atlantic, or Air France, all of these airlines are saying, we've been through a pretty rough patch. The good news is it's holding up in the front of the cabin. That's where the real money is made. So the business class end of the cabin, that's still relatively stable. It's at the back end, the more price-sensitive people, that's where things are a little bit patchy or choppy, as Ed Bastian called it. But they have some hope that coming into summer, going into the latter part of the year, people will have moved on from this and will start booking again.
Benny, I got to ask about Boeing. As a trade tool, Bank of America has raised its rating on the shares to a buy from a neutral because President Trump seems to be using Boeing to negotiate deals with other countries, kind of enticing other countries to buy more planes. On the other hand, President Trump himself doesn't seem terribly thrilled with Boeing. Listen to what he had to say on Friday.
Well, it's here already.
Yeah.
It's in the country. It's being refitted for military standard.
How much will it cost to refit it?
Oh, I don't know. Whatever it is, a hell of a lot less than building a new one. We're waiting too long from Boeing. Boeing has got to get its act together.
All right, so I could have prefaced that better by pointing out he was going to be talking about his new, to him, used jet from Qatar. But the point being, he doesn't seem terribly thrilled with Boeing.
Yeah, this is sort of a love-hate relationship that's been going on for a while. Boeing, on the one hand, is a national champion, is sort of the national champion. They are the biggest exporter. They make visible, big made-in-America products, only made in the U.S. All the aircraft that Boeing sells are made at home. They have a huge sort of trade surplus as a result in terms of aviation products. So in some sense, they should be a national champion that they should protect, the government that is. On the other hand, as we just heard, they are not getting the plane that Trump really wants, which is the Air Force One jet, to him on time, which is why we got into this whole hot mess on the Qatari plane. But the bottom line is he can use Boeing products as a diplomatic tool. We saw it in the Middle East, where he got a massive deal out of Qatar Airways. We'll probably see more of those going forward. So as long as he can sort of wield Boeing as a tool to get favors and sort of go either way, then it's actually something that's quite good for Boeing. We'll probably see more deals going forward. We have the Paris Air Show in about 2 weeks. That's traditional a venue where Airbus reigns supreme, but you should expect Boeing to walk away with some deals there. We might get more out of the Middle East. We're hearing some companies are still in buying mode. So they're not done yet, and that will be good news for Boeing, which is why you're seeing these upgrades.
Got it. Benny, thanks so much for joining us. Bloomberg's Benedict Campbell leads our global aviation coverage out of Berlin. And Katie, you've been pretty excited about Boeing for at least, I'm going to say at least a year, as long as this show's been
year. As long as we have
air.
been talking intensely every single day. I'm interested in Boeing just because it feels like one of those things that are too big to fail. How could the U.S. government let Boeing fail? We're obviously not anywhere close to that.
It feels almost like a state-owned company.
A little bit. You could make that argument. I wanted to take a look at Boeing shares year to date because they're up 17% on a total return basis. You compare that to the S&P 500, which is pretty much flat. Of course, the obvious pushback is that you just zoom out a little bit. Boeing falling 32% in 2024, but still, the rebound year to date is remarkable.
I mean, I pull out 5 years. I always default to that because of the comp function on the Bloomberg, and they're up double that over 5 years, so 35%. The interesting thing is that you see a bigger drop. Sorry, I have Air France. I put Air France here.
Air France. You meant Airbus.
I meant Airbus, yes. If you look at Airbus over the same period, it's up 172%.
Yeah.
So they're doing a little bit better. There's two plane makers essentially in the world, and Airbus is crushing it.
Yeah, it was pretty funny. Last year, the pair trade was Boeing, short Boeing, long Airbus, because Airbus rose about 10%. But we'll continue to track Boeing, whether or not Matt likes it, because I think it's fascinating.
I just love talking to my buddy, Benedict Campbell, and I wish we could get Guy Johnson on this show. That would be a real coup if we could book him.
He's booked, he's busy.
Yeah. Coming up, RBC just raised its S&P target. Will Citi's Stuart Kaiser do the same? We'll put him on the spot and ask him that question live on internationally broadcast television. This is Open Interest.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Welcome back to Open Interest. And RBC strategists have raised their year-end target for the S&P 500. The team, led by Lori Calvasina, now sees the index at 5730 by 2026. That's still about 3% below the benchmark's close on Friday, but a raise nonetheless. Let's discuss, because joining us at the desk is Citi Head of U.S. Equity Trading Strategy, Stuart Kaiser. Stuart, we said that we would ask you if you would raise your target. We have since learned that you don't formally have a target.
Or informally.
But if you did, would you be raising it right now? How do you feel?
I mean, I think from our perspective, you're still about 50-50 on recession risk. So, chasing the market here from a price target perspective, I think is just, you could be kind of cutting it again, very quickly. And I think, honestly, that's the big debate going on in the markets right now is what are the odds of recession? If we do get that recession, you're going to need earnings considerably lower from an estimate perspective. And that's probably going to drag targets a little bit lower. If we're able to skip past this recession like we have for the last 2 or 3 years, then, yeah, I think these higher targets are going to make a lot of sense. So I think you're really taking a view on a recession, which, you probably put as a toss-up right now to begin with.
I was looking at the top of your note, which I'm guessing you published before Donald Trump spoke on Friday. Because you said just when the tariff headlines fade away, we worry about, the national debt. And now we have tariff headlines back as well. So can't you raise those odds a little bit on recession?
Well, I mean, look, we joke, Donald Trump has made weekends interesting again, right? A lot of people want to own those Monday straddles ahead of a Trump weekend just to avoid the headline news. It's a tough call on that. I think our view had been, unless you get tariffs resolved relatively quickly, then the kind of cumulative impact of an uncertainty shock and fiscal restraint, et cetera, does significantly raise recession risk. So, yeah, I think the longer this stuff persists, then clearly you have to discount a higher odds of recession the longer this stuff goes on.
All right, Stuart, you're going to stick with us. We're going to come back with the opening bell. As futures fall this morning, as Katie pointed out, it was a pretty banner May, the best May since 1990. We're back in 2 with the start of trade.
at Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, you know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area that comes out in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
We are moments away from the first day of trading in the month of June. This is Bloomberg Open Interest. I'm Matt Miller. Looks like we're going to kick it off on a negative note, a little bit of a drop in futures. Not too bad, 0.3% on S&P futures, 0.5% on NASDAQ futures. After the U.S.-China trade war kind of reignites and Donald Trump doubles tariffs on steel and aluminum, that's pretty good considering. Take a look at the opening bell at the New York Stock Exchange. That guy's super psyched. Diamond Rock Hospitality celebrating their 20-year anniversary. They've been listed for 20 years, and the stock is up 32%. I feel like they can do better. Down at the NASDAQ, you have Charles River Associates. They're celebrating 60 years. I didn't go that far back, but over the last 4, they're up 400%. So they are absolutely crushing it. And I guess signing the opening bell at the NASDAQ. Katie's looking at some stocks that are moving pretty big on those tariffs I mentioned. What do you got?
Absolutely. Let me tell you about them. We're keeping an eye on aluminum and steel stocks, of course. They're moving mostly to the upside after Trump said he would double the tariffs on those metals to 50%. That is in an effort to aid the Nippon U.S. Steel deal, according to the president. Let's take a look at the fallout right here. You have U.S. Steel actually down a little bit right now. That has some idiosyncratic factors going on. So you take a look at Nucor and Cleveland-Cliffs, both up in a big way. Nucor, 11%. Cleveland-Cliffs, even better, Matt, soaring right now, up 23% at the open.
All right, let's get to that's the steel news, and there are a lot of moves there, but also, and bigger, moves in healthcare. Bristol Myers Squibb is going to pay BioNTech $11 billion to license its next-generation cancer drug. Sanofi is buying U.S.-based Blueprint Medicines in a $9 billion deal. That's also an immunology company. And then Moderna is doing something with COVID. We are back with... Wait, that was it? We're not going to...
That was it.
I thought... Oh, okay. I thought I was introing... We're going to get to...
Don't worry, it's coming up.
We'll get to Sam Fazeli in a little bit out of our Chicago bureau. We're back, though, with Citi head of U.S. equity trading strategy, Stuart Kaiser. So I guess we're talking about a couple of sectors here, which gives me an opening to ask you what sectors you like. If I have $1 million and come to you, where would you put it?
I think from our perspective, we still like the safety of large cap growth, so we still want some tech and comm services exposure. And the second to that, I think,
Mag 7.
Yeah, Mag 7-ish. Maybe you go down, cap structure a little bit, just given the size of the moves in that space recently. And then banks. I think banks is an area where people still want to be engaged. All the deals you're announcing is exactly what investors were hoping for at the beginning of the year. If they do roll back SLR and give banks a little bit of an opportunity to expand balance sheet, I think that should be incrementally positive as well. Well, that's been about 12 months. It was actually right around this time last year where that banks trade kind of kicked off, mostly from a deregulation angle. Now we're getting into the deal calendar, hopefully. So that's an area we would like to have exposure as well.
Okay, well, let's say I needed to fund those positions somehow, that $1 million that I wanted to put into large caps and into banks. Say I had to take it out of a certain sector. Where would you do that right now?
I mean, that's the tougher call. I think that's pretty nuanced trade at this point. I think you still want to be very careful with tariff risks. So things like consumer durables and apparels, I think, which have a lot of that tariff risk, I think you need to be careful with. Energy does seem to be continually a source of funds, particularly given, Trump's motivation to keep oil prices low. So those are probably two areas where we're a little more cautious. I would have told you healthcare, but, once you get these deals kicking off, I think you want to be a little bit careful with the deal risk in healthcare. But, that was obviously one of the worst performers last month as well, because it's been just a regulatory waterfall on that space. If you talk to PMs in the space, every time they think the stuff's fully priced in, you kind of get more news. But again, once you get deals being announced, I think you want to be very careful, especially in mid-cap biotech.
It's interesting to hear you say that on healthcare, because that was one of the bull cases coming into this year for the industry in 2025. And you saw a little bit of that in January pre-inauguration with Johnson & Johnson, for example.
Intracellular.
Exactly. Then it was put on ice for a couple months now. Maybe it's coming back.
Yeah, we're starting, now we see another 20 billion in deals. That was, I think, 15 billion. I thought you were going to say you fund these things like the double line way, right? Shorting 30-year treasuries.
You could, I suppose.
And that raises, I think, a real concern. We're not there yet. Shanali's chomping at the bit for long yields to get out of control, but we're at 5% on the 30, right? 4.5 on the 10-year. Are you watching this closely? Are you worried that they may rise too much when everyone realizes we are spending way more money than we take in?
Definitely very, very, very concerned about it. I mean, we definitely saw real money kind of step in around 5 to 5.1% to kind of buy 30 years. But I think you have two risks here. One, you have just sort of a global spillover risk, which is if you get longer term yields to dislocate in Germany and in Japan, that can just force U.S. yields sort of mechanically higher. And the second is once we get this budget deal announced, it's not going to quote unquote score well from the CBO, and you could get pressure to the upside there. And I think incrementally what you worry about, clearly you have a supply-demand issue, but also you just have a lack of tools in the toolbox right now from both the Fed and the Treasury to really address this other than with languaging. So they're going to try to push back as much as they can verbally, but if they really need to step in, you're talking things like QE or pulling 20-year bond auctions, which we think are kind of last resort type situations. So you have a spillover issue, you have a budget issue, and I think you have a how do they deal with this if it actually happens issue.
On this topic, there was an interesting note out from David Kostin at Goldman, I believe your former boss, who wrote that many investors point to 5% nominal yields as sort of a danger zone, a tipping point for stocks.
On the 10-year.
Yes, on the 10-year. He writes that we are less convinced, saying that it's more about the drivers and the rate of change rather than a specific level when it comes to yields. I'm wondering where you fall on that question. I mean, do you have a level in mind, or are you also focusing to the changes and the speed of them?
It's the speed of the change, and to David's point, it's what gets you there. If you're at 5% because U.S. growth surprised us to the upside and it looks like we're getting a true soft landing, then yeah, clearly 5% is not going to matter too much to equity investors. If this is a supply-demand issue or an inflation issue, that's a completely different discussion. So yeah, I don't think obviously, it's interesting, and we do it too. Like whenever you come up with a key level, it always happens to be a big round number as well, right? It's always a 4.5 or a 5. I think David's spot on though. It's the rate of change, and I think most importantly, what is getting you to 5% is based on how equities are going to respond. The fact is, May was the best equity versus bond month in about 3.5 years since October 2022. Is that sustainable? Can equities continue to rally as bonds sell off? Our view would be yes, if it's growth driven. If it is inflation or sort of systematic risk driven, then no, then you're in a different story.
All right, Stuart, it's always great to see you. Great to kick off the second half of this year with you. That is Citi's Stuart Kaiser. And let's take a check on how this market is faring on the first trading day of the month of the second half. You can see the S&P 500 is down very slightly when it comes to the overall benchmark, but breadth is in the toilet right now. You only have 86, 87 names in the green right now. A lot of movement to the downside with more than 400 names in the red. You take a look at what's working right now. You do have NVIDIA higher. That's helping this benchmark. The same with Broadcom, Meta, Apple, United Health Group. But then you take a look at what's weighing on the benchmark. It's Alphabet, it's MasterCard, it's Johnson & Johnson, all some of your biggest decliners right now. So let's take a look at the sector level as well and break it down that way. You can see this poor breath when you take a look at the bars as well. You have energy and tech gaining right now, but then you take a look at the bottom and it's a sea of red. You have real estate and financials at the bottom. You also have healthcare in the red, middle of the pack right here. And I think that's really interesting because if you click into that, you can see some of these deals news names that we've been talking about so far this morning. I go straight to Moderna, for example, getting FDA approval for a narrow group of patients for a new COVID drug. And then you have Bristol Myers Squibb, of course, up 0.7% right now. So let's zoom in a little bit more on that because they announced this morning a licensing deal with BioNTech, and we're going to discuss that now with Sam Fazeli of Bloomberg Intelligence. And let's go there. This is a conversation, Sam, we were having at the start of the hour about how it seems like cancer is really the hot area when it comes to these health industry deals right now. Would you expect to see more of the same?
Yes, absolutely. I mean, look, I'm in Chicago for the largest cancer conference that comes around once a year. And frankly, you see some of the evidence and the data that's coming out. And I've been bullish about cancer in general in terms of treatments that are coming along for quite a while now, because pretty much at every conference, we get a big step change or practice changing data. And here, the deal that you've just seen Bristol Myers do with BioNTech is on a new asset class. And interestingly, a whole bunch of those assets are just coming out of China. No one else has been developing them in Europe, US. And it's a new asset class that could, I want to emphasize could, revolutionize the treatment and immunotherapy again over the next 5 to 10 years. Could, not will.
So, by the way, do you think we're going to see more big deals? We were talking, Sam, about the fact that it looked pretty cold. I mean, we did see J&J Intracellular at the beginning of the year, but it looked pretty cold after that. And now we've seen 20 billion in one day, potentially more, potentially less, but around that. Is it going to start heating up, or is this just that, you know, Chinese treatment BNT 327 that's kind of making waves?
Right. No, so it's partly that. The Sanofi deal that you've just been talking about also, that is not to do with oncology, that's immunology. That's what Sanofi believes is a key area that it wants to focus on, and I agree with them. Immunology, your immune system, touches pretty much every disease that there's out there. Now, the thing is, the sector started off excited, and then we had the administration come in with a whole bunch of issues that they brought up that are negative. I think your previous guest spoke about it. That just gave people pause. I've banker friends who say, look, we had a big book of M&A deals at the beginning of the year, and it all just kind of stalled because of this. Is this a restart of that? I'm a bit worried that in the next couple of weeks or 3 weeks, as my colleague Dwayne Wright in Washington says, we might hear about that most favored nation or the tariffs. And that's the thing that we're going to have to, or more about them at least, that we're going to have to worry about, that suddenly, again, putting a halt on people being enthusiastic about deals.
Yeah, absolutely. A lot of folks sort of holding their breath when it comes to more tariff details there. I do want to talk a little bit about Moderna because shares are rising this morning, which it feels like is pretty rare to see. The reason why is because Moderna won narrower U.S. approval for a new COVID vaccine, sort of limiting the new approvals to folks who have some underlying risk factors, which is different than previous approval. And you can, again, see shares rising. But Sam, this is a real question, not flippant, but how many people are actually still getting vaccinated for COVID?
Yeah, so with all the questions that are being thrown at vaccines by some people in the administration, I think you have to worry that when it comes to actually people taking the shots in their arms, remember, vaccines are useless unless they're actually administered, right? People getting them shots in the arms. I'm a bit worried for going into that season. The narrower approval is as expected. I think the reason Moderna is up is because the approval came on the day that it was expected, or at least the last day that it could have come by.
And so it shows that the administration and the FDA are still doing their job in terms of getting things approved. But what you need is the push to get people to go and get them. Not push necessarily, but the encouragement. I mean, it is a personal choice, but vaccines only really work and protect the population if a lot of people take them, not just a few.
Yeah, right. If I am the only one who takes it and then everybody at Madison Square Garden for Fish doesn't, then I'm going to get COVID, basically.
There you go.
Sam.
I mean, it doesn't help our issue in that one of the things you want to do here is reduce hospitalizations. You need a lot of people to take them to really get that benefit.
All right. Appreciate the PSA. Sam Fazeli there of Bloomberg Intelligence talking mostly about cancer drugs, and we're hopeful there, but some about COVID. Coming up, Stars setting out on its own and impressing in its first quarterly report. Jeffrey Hirsch, the CEO, joins us next. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Stars shines in its first report since its separation from Lionsgate. The entertainment company added 530,000 streaming customers in the fourth quarter, and Stars says it's now focused on improving margins and streamlining its strategy for original content. Joining us now, I'm pleased to say we have Jeffrey Hirsch. He is the CEO of Starz. Jeffrey, great to see you in person.
Hey, thanks for having me. Excited to be here this morning.
And I have to imagine this is some validation, a real proof of concept that Starz should be a standalone business.
Yeah, look, I think the corporation made the right decision to separate the companies and put the value in both the sides of the Lionsgate side and the Starz side. I think you're seeing the great decision by the board coming to fruition with the stock price on both sides moving and putting the value in the right place on both companies.
So what is your target audience? I mean, we were just talking a little bit during the break about HBO Max has made a number of changes. You've worked there too. So what are you doing at Starz? What's your focus?
Yeah, we're really focused on really two core demos, women and underrepresented audiences. When we launched our OTT product in April of 2016, what we saw was driving our business was women. And so we leaned into that very significantly, and our programming mandate now is narratives for, by, and about women and underrepresented audiences. So shows like Outlander, shows like P-Valley, the Power franchise really leans into that. It's very adult, very R-rated. We don't have any advertising, and so we'll continue to really focus on that. And that makes us a very complementary bundling partner to most of the broad-based streamers out there that you see today. So we think we're really uniquely positioned in a very competitive space today.
So R-rated content, not something that you would pop on
We used to call it Skinamax, but that's what you are now, right?
No, I think we're a little more elevated in terms of scripted dramas, but I appreciate the reference.
Yeah.
No, look, I think there was a time and the place that Cinemax had its run back in the day, but you know, we've got some of the biggest shows on television with Outlander. We have the prequel coming this summer on August 8th. We premiere BMF this weekend, and these, you know, it's really more of where the story goes naturally, we go there, right?
So
we
BMF
don't,
is Black Mafia
family, yes. It's 50-cent show, really big show for us. We're excited to have it come back on the service. But for us, you know, when the natural story goes to certain places, we allow our creators to go there, whereas other services kind of pull them back because they want to put ads against it.
So there's plot, of course. And I mean, you think about Game of Thrones, the best television show of all time, in my opinion, obviously was R-rated.
I hear people in this office saying that about Outlander. I mean, they love it.
True,
yeah.
true.
I mean, Outlander is one of the biggest shows on TV, and you know, we have a prequel coming which takes us back to 1700 Scotland, and it's the love story about how each of the leads from Outlander's parents met and fell in love. So there's a little bit of a Romeo and Juliet story on one side where it's forbidden clans and they fall in love, and the other side is a World War I story. And so we're really excited about it. But I think all of our shows are, you know, we have 5 shows that do between 9 and 12 million eyeballs a week. Those are some of the biggest shows on TV, and so we're really excited about our content strategy and the place that we play in the whole ecosystem.
This leads nicely to my next question. We heard from your chief financial officer recently on your conference call with analysts saying that you see roughly $700 million of content spending in 2026. Can you give us more detail on that? Is that for some of your existing franchises, your existing shows, or you also are you putting that towards developing new content?
So what's in that number is a combination of our big originals. There's a Lionsgate Pay 1, which is the first movie windows that come to that, and a Universal Pay 2. And we think that the portfolio of content really makes us a very compelling service at our $11 price point. And you saw that in the first quarter numbers. We actually grew the U.S. subscriber base total by almost 2% in the first quarter, which is a really, really good accomplishment in a very competitive space. But we have a programming group. We've got 40 to 50 shows in development at any given time. And as we talked about on the call, we want to go from a 15% profit margin to a 20% profit margin by end of 2028. One of the ways that we get there is actually by turning the slate over and putting new shows on the air that we can own as we separated from Lionsgate. And so ownership economics is really important because season 1s are much cheaper than seasons 5, 6, and 7. Right. And we can also put international sales back into the business, which is another way to net down the cost of a show. And so as we separate, we just announced that we opened 4 writers' rooms in the last couple of weeks on some really compelling shows that I'm excited about. As we start to move into 27, you'll start to see more of our own shows come on the slate.
I imagine, you know, with something like Outlander, you can get people to come and pay $4 a month, which is what your special offer is right now. Can you grow that over time as you have these massive competitors like Netflix, like HBO, or do you have to hold it at a lower level?
So, one, we don't see them as competitors. We see them as complementary services. If you think about the old traditional world, Stars was always set up as a cherry on top or an additive to broad-based services. So Comcast for a long time sold Stars on top of expanded basic television. We think that world gets replicated in the digital world, and so we've always positioned ourselves as being a complementary add-on to the broad services like Netflix, like Amazon, like Hulu. And so we will always be priced well below the broad-based services so that we are viewed in the consumer's mind as complementary and not competitive.
Before we let you go, I do want to talk a little bit about your business, because I believe you derive about 70% of your revenue from streaming. That leaves about 30% of your company exposed to, cord cutting. So how do you plan to deal with that over time? Is that something that you're trying to whittle down, that 30%?
Look, we really follow the consumer, right? And so as the consumer has shifted from linear to digital, we kind of followed the consumer there. But I think there's a real value in still the linear business today. What's interesting about all of our customers, 80% of all of our customers are either added on or a la carte, which means customers chose Stars. It wasn't we're in a bundle, and so that we see the cord cutting and we're just the natural evolution of cord cutting. People have actually picked Stars because the content is working. And what it also means is that we actually are a revenue generator for our partners. And so I actually think that there's a lot of opportunity still in the old traditional world for us as the content continues to roll out, that there's opportunities to grow that business. And actually what we saw at the end of the first quarter was a lessening of the cord cutting loss. Now, it's a little bit of time. I wouldn't claim victory on that yet, but our hope is that loss starts to slow, and that's additive to the long-term health of the business.
All right, Jeff, great having you on the show. Thanks so much for joining us.
Thanks for having us.
Jeffrey Hirsch there, the CEO of Stars. Got to get a quick check of what's going on in markets right now. We did see a turnaround for a bit on the NASDAQ. It's back down. I think NVIDIA and some of the other Mag 7 stocks are really holding it up there. We saw most of them gaining, right?
Yeah.
Alphabet, Google was down, but you had NVIDIA up as well as Apple and...
Yeah, when you have more than 400 stocks lower, even the might of NVIDIA and some of those Magnificent Seven, you can see sort of it comes out in the wash. We're going to get into it next. Don't go anywhere. This is Open Interest.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a check on stocks. The first day of June trading down. The S&P 500 off 0.5%. The NASDAQ down 0.25% as the VIX rises up a little bit. Take a look at some of the movers here. NVIDIA, as Katie pointed out, is not enough to undo the damage done by the other 400 stocks that are down right now. Tesla, for example, is down as well. We come back. Raquel Oden joins us of HSBC. She says to expect a wave of earnings upgrades.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up to the minute economic news, whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. A court appearance is scheduled in Colorado today for a man accused of using a makeshift flamethrower to lob Molotov cocktails at a group of demonstrators honoring Israeli hostages in Gaza. CBS's Anna Schechter.
The FBI said the suspect yelled "Free Palestine." Multiple videos posted to social media showed the suspect shouting, "We need to end Zionists."
8 people were injured. The suspect, an Egyptian national with an expired visa. Correspondent Jason Allen is in Boulder.
Still a lot of shock here that something like this could happen in an area that's calm normally. This is pedestrians that go through here on this closed Pearl Street, this Pearl Street Mall, and something they've been able to do week after week after week without any issues until what happened here yesterday.
Just in from Washington, the Supreme Court is declining to hear, for now, a challenge to an assault weapons ban. The case from Maryland involves semi-automatic rifles like the one used in the mass shooting at Sandy Hook Elementary School in Connecticut that killed 20 children and 6 adults. A second round of Russia-Ukraine peace talks has ended almost as soon as it began. It came a day after Ukrainian President Volodymyr Zelensky announced what he called a brilliant drone operation that devastated Russia's Air Force. CBS's Ramy Inocencio.
He said Ukraine managed to launch over 100 drones, that each one was flown by its own drone operator, and that they were launched from inside Russia, targeting 5 air bases across the country.
Senate Republicans are back in Washington with hopes of passing what the president calls one big, beautiful budget bill. A GOP holdout, Kentucky Senator Rand Paul. Politico's Mia McCarthy.
He's a big deficit hawk. He has, really pushed for having bills that don't increase the deficit and has been very consistent in voting against legislation that does.
A former Trump loyalist in Idaho is fighting to return her January 6th pardon. CBS's Steve Catham.
Pamela Hemphill is one of more than 1,500 people Trump pardoned earlier this year for their roles in the Capitol insurrection. She has sought help from her Republican senator to formally refuse and block the Trump pardon issued back on January 20th.
Hemphill tells CBS News, "We were guilty, period." A giant plume of dust from the Sahara Desert is floating over the Atlantic on its way to the U.S. CBS's Rob Marciano. on Captiva Island.
It's over Puerto Rico. Actually, air quality issues are poor there. It'll probably come over South Florida as well over the next couple of days. So it brings its own issues. But the good news with the dust, it does knock down hurricane activity.
This is CBS News. A celebrity couple says, I do.
Buffalo Bills quarterback Josh Allen and actor Haley Steinfeld have tied the knot. The Oscar-nominated actor wore a white strapless gown while the QB was in a black and white tux in the Southern California sun. The nuptials came less than a year after the couple got engaged, which happened during the Bills' bye week in November. In March, Allen signed a 6-year, $330 million contract extension. Matt Piper, CBS News.
This may be true.
A kiss is still a kiss.
But a new study from Iran finds kissing can lead to depression and anxiety. Researchers there claim those two conditions can trigger the release of the stress hormone cortisol, which in turn can disrupt the delicate balance of bacteria in your mouth. The study was of 268 newlywed couples. Previous ones have shown as many as 80 million bacteria are transferred in a 10-second kiss. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience streaming live on YouTube as well. John Tucker just asked the best question. Why is oil up? I've been asking this all morning, and the answer is...
Dun, 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 short covering.
Short covering.
Nice. Into the OPEC meeting, lots of Brent shorts. Out of the OPEC meeting, short covering rally.
I had all morning, I was saying, I'm going to wait till Alex Steele gets in here and tell me why oil's up. So there you go. All right, we got a lot going on here today. We're going to check in with Susan Spence, chair of the ISM. We had some weak manufacturing data come out again today, fourth month in a row. We'll break that down. We'll talk to Ender Kern, Bloomberg Global Economy reporter, on the global trade tensions out there. Craig Trudell, Bloomberg Autos editor. Susan, Tesla sales plunged 67%. And almost 3-year low in France. So we'll get the breakdown there. Let's go right to Susan Spence. She's the chair of ISM Manufacturing. Susan, talk to us about this ISM Manufacturing. Came out at 48.5. The consensus was 49.5. Tell us what's going on.
Good morning. Thank you for having me on. Unfortunately, we have another month of contraction, about 0.2% lower than last month. So 48.5, we are absolutely under consensus. What we're seeing and what our panelists are telling us, of course, is a continued issue with uncertainty in the market driven by tariffs. So this month, if I can talk about demand, outputs, and inputs, demand, which is new orders, customer inventory, backlog, and new export orders, 3 of those 4 indicators continue to contract. Backlog and new orders contracted a bit slower this month at a slower rate. New export orders, not surprisingly, took another plunge and an accelerated reduction at 3 percentage points lower. So in our view, the lack of new orders driven by that uncertain demand from the marketplace, the conflicts of who's going to pay for the tariff costs, The customer index for inventories does remain low. We always consider that positive. At some point, customers have to reorder, and so we're hoping to see that, but that continues to contract. So in our survey, 86% of the general comments from our panelists were about the tariffs. It was 82% last month. It just continues to grow. It's not gotten any better, and certainty is even worse.
Susan? Susan, do you get the sense that if some of the tariff headwinds were removed, things get better quickly, or is this sort of permanent confusion in the manufacturing sector?
It's not permanent, but it's not quick. So we think if tomorrow everything was settled, and of course it won't be, we think we're in this for at least the summer, it's going to take some time. We already have some inventory at the higher prices. Customers, again, as indicated by the survey results, are hesitating to order. And so that has driven down production, backlog is down, and I'll talk about production and employment as well. So we're in it for a bit. The best thing that could happen is certainty. And then my personal belief is it's still going to take a few months for folks to not wait for the other shoe to drop, if you will.
Susan, thank you so much for giving us a couple minutes of your time. Susan Spence, Chair for ISM Manufacturing PMI, the Institute for Supply Management, joining us here. Weaker than expected manufacturing numbers coming out this month. Right now, let's get a reset. We'll go to John Tucker and a Bloomberg Business Flash. John.
All right, the major stock averages, they are lower on this first trading day of June. This Bloomberg Business Flash being brought to you by IBKR. Will the median new home sales price exceed $420,000 in May 2025? At IBKR Forecast Trader, the S was recently at 37%. Start predicting today at ibkr.com/forecast. Last trading day for this contract is June 23rd. You just heard from Susan there. The ISM Manufacturing Index continues in contraction territory. Major stock averages lower right now. The S&P 500 down 32. The Dow down 315. The NASDAQ 163 points lower. 8 of the 11 major industry groups in the S&P 500 down right now. The exception, energy, is the biggest gainer because, as Alex said, short covering, that is pushing oil prices higher right now. China accusing the U.S. of violating the trade deal. President Trump says he's going to double tariffs on steel and aluminum metals. And then you can add more geopolitical risk as Russia and Ukraine's peace talks ended in just an hour. Laura Cooper at Nuveen says tariffs back in the driver's seat for investors.
I think the key question, though, is to what extent will the economic damage be from not only the tariffs to date, but as well this ongoing uncertainty around the policy. And I think investors are crucially watching for that next step in the data.
Do they have a problem with Elon? Tesla sold only 721 cars in May in France, down 67% from a year earlier. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, thanks so much. Happy Monday, everybody. Alex Steele here alongside, what's your name? John Tucker and Paul Sweeney. All right.
I get that a lot.
Yeah.
What's your name?
At least he didn't call you Charlie Pellet.
He keeps showing up, though.
He keeps showing up, and I appreciate you being Alex on Friday. All right, let's take a look at some of the stocks on the move. Alex Steele, Paul Sweeney. We're joined now by Bloomberg's Anitza Sakova. All right, you're taking a look at Boeing. That stock up 0.7%.
Yeah, it was a much bigger gain early in trading, but Boeing ticker BA had a really strong start of the day. Of course, markets are selling off now, so that's definitely dragging. But it's coming on back of an upgrade from Bank of America, which upgraded it to buy. And actually, currently, their target price is the highest on the street. We're talking about $260 price tag. Bank of America Securities upgraded the stock, and they actually see it as a very interesting to benefiting from all the trade war. The analysts wrote that the company's aircraft emerged as favored trade tool for Trump administration. They mentioned a few examples, including the deal with Qatar Airways and also China ending their ban on airlines taking deliveries from Boeing. And clearly, this is one winner emerging. We had earlier this year, Boeing winning this contract from the government. There are also some fundamental reasons in the note. They're quoting progress in stabilizing production. And overall, this is boosting the stock. The stock is up 20% year to date, which, as we remember, last year was pretty rough. So quite a revival there.
It's all about deliveries of the 737. That's what George Ferguson told me, and that drives the cash flow. So hopefully they can continue to ramp up production there. How about Moderna?
Yeah, another move higher on vaccines. Obviously, those stocks have been very volatile. They had about 5% jump in early in trading. Now we're seeing about 2%. This comes after the drug maker won FDA approval for its second-generation COVID vaccines. So 2 groups. Adults over 65 and anyone over 16 who has at least one risk factor for severe disease. It's interesting that initially the reaction was very positive, and we see that some of the analysts are weighing on this, that maybe it's not that big of an improvement. For example, William Blair says the approval is incremental win for Moderna, and obviously with Robert F. Kennedy in the administration, there is a lot of obstacles for vaccine makers. And also they say does not see the approval of new vaccine as a massive boost to sales, which obviously is important. That said, people were prepared for way worse developments for vaccines, and so far we're seeing some positive lights there. So we've seen a lot of jumps up, and obviously some retracement, some volatility down as well.
All right, Denitsa, we really appreciate Denitsa Sakova joining us. For more conversation just like this one, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere else you listen. All right, global trade tensions back in the front and center. That's what we keep hearing. And a current Bloomberg Global Economy reporter joins us now. I would argue maybe the trade tensions never left the front burner, but nevertheless, do we feel like the escalation between, say, U.S. and China is real, or is it just bluster?
It's just like, the latest episode in an ongoing kind of drama, really, Alex. But your point, at the very least, it does show that we had that kind of cooling off meeting in Geneva between the US and China where they agreed to bring down tariffs on each other and sort of set out a pathway for talks on working out some of the other issues. But in the time since then, of course, we've had a couple of things going on. On the one hand, the US clearly not happy with the state of progress in those talks, not happy that China aren't releasing rare earth minerals at the pace they expected. That's one of the US complaints. On the Chinese side, and in particular we had this from the Commerce Ministry overnight, they're making the point that the US is pushing ahead with export controls on AI chip software, and of course that big move on student visas, in particular the threat to revoke student visas of Chinese students that was announced last week. And by the way, we also have, of course, on the geopolitical front, the warning from the Defense Secretary in Singapore over the weekend that China continues to have ambitions towards Taiwan. None of this suggests a kind of a smooth or linear pathway to reaching any kind of a near-term trade agreement that would diffuse all of these tensions, and that seems to be what's bubbling up again.
And are we going, we being the United States, from a trade perspective, are we going country by country by country by country? Is that the strategy?
Well, it's a little bit complicated at the moment given the court ruling last week, which has certainly clouded some of this, but nonetheless, I think the messaging seemed to be from the administration that in truth they were dealing with some big trading partners on the European side, and of course we had that initial agreement with the UK, and then the big Asia exporters, trading nations, Japan, South Korea, Vietnam and the like, and obviously the China talks carrying on in parallel. That seemed to be the focus. I mean, I think the messaging was that they're not literally dealing with every country in the world, they're trying to get some big ones off the block. The question mark becomes how much leverage does the US lose or not lose on account of that court ruling last week on many of those tariffs that were imposed in the first instance. There are those who say what country would want to come to the negotiating table and give concessions while that court process plays itself out. Obviously the US administration makes the point that that is immaterial to what it's trying to achieve anyway, and even if the court's process fails them, they have other routes to go in terms of imposing tariffs. But nonetheless, at the very least, it is a confusing additional point to this as the US does try to achieve some kind of trade agreements with major trading partners in the near term.
Right. And also wonders, too, are we going to see carve-outs as we keep getting specific industry tariffs, like with the steel and aluminum? Like, do we get more carve-outs as then trade negotiations continue?
Well, that's the expectation. It's going backwards and forwards. Of course, last week we had the surprise announcement of the increase in tariffs on steel and aluminium to 50%, for example. President Trump making it clear that he remains, that he has the authority to move when he wants to in some of these matters. And we still expect, of course, those reports are due back to the White House in terms of sectoral tariffs on maybe pharmaceuticals, maybe on semiconductors, maybe on lumber, maybe on other areas. But there's no doubt that, of course, certain industries will be appealing for exemptions and carve-outs. We've already seen that on the consumer electronic goods coming out of China, for example. We've seen it on some other products as well. Every trading partner coming to the table will have their special plead, their special begging bowl in all of this. So ultimately, there will be some exemptions, Alex.
All right, Enda, thanks a lot. Really appreciate it. Enda Curran, a global economy reporter, joining us. Always love the insight. Thanks very much. All right, coming up, Craig Trudell, Bloomberg Autos reporter globally on Tesla sales plunging. Also, higher steel tariffs. That cannot be good for some of the automakers. We are going to break that down. Happy Monday. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg News with this Bloomberg Business Flash, and we are being brought to you by Oracle. Attention growing businesses, Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. So at the top of the hour, we got the manufacturing data. It wasn't great. ISM factory activity contracted in May for a fourth consecutive month. You also had that gauge of imports. That was an eye popper, falling to a 16-year low. That's pushing stocks lower. One of the factors pushing stocks lower. S&P 500 down 24 points right now. Down 0.4%. We're at 58.87 on the index. The Dow Jones Industrial Average down 248 points. The Nasdaq 100 44 points lower. Two-year yield up a basis point, 390. 10-year up 3 basis points, 442. The long bond up just about 3 basis points, still under 5, 496 there. Energy, best performing major industry group. The price of crude oil jumping roughly 3%. That's West Texas. Bristol Myers Squibb will pay BioNTech as much as $11.1 billion to license a next generation cancer drug. The competition really intensifying in an area of oncology that seeks to harness the immune system to attack tumors. And here's one for you. I don't think you're going to like this one, Paul. Amtrak's Northeast Quarter will see a drop in grant funding under President Trump's new proposed budget request. So the administration is proposing a roughly 25% decrease for Amtrak in the Northeast Quarter.
Why?
I'm going on a Acela down to D.C. today. So I'll be on it. I'll report back.
The last time I took it, it was cheaper actually to fly out of LaGuardia.
I am not flying into D.C.
No.
There's no way I'm flying into Reagan for like multiple
Michael
reasons.
McKee can do that, but regular people, no.
There's lots of reasons why that's not a thing.
I flew in once, and we were in a small plane, and they told us the tower, you got to come in, there's somebody behind you, got to come in faster.
Yeah.
Because there's a big jet behind you. So we had to keep the landing gear up at the last second, and I turned to the pilot and said, the landing gear isn't down.
Right.
Last second, it locked in place and we landed.
Yeah. See,
If I hadn't been there, Alex.
There you go. Who knows what would have happened? All right, John Tucker, Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. One headline that's catching everyone's eye right now is Tesla sales plunging 67%, almost a 3-year low in France. Craig Trudell is Bloomberg Global Autos reporter, joins us now. Hey, Craig, what's the reason behind this?
Yeah, the association that reports these numbers doesn't necessarily give sort of manufacturer by manufacturer analysis, but I think what's really stark here is just how sort of consistently bad Tesla's numbers have been in France this year, and how that has continued even as the company has rolled out a redesigned version of the Model Y. So there was a lot of sort of concern about the damage that Elon Musk was doing to Tesla's brand early this year, but also some people who said, well, hang on a second, they're redoing their most important vehicle. Let's allow that to sort of hit the market and see how the company fares. Once it has that arrow in its quiver, it now has that vehicle to sell, and registrations are still slumping mightily. For the company to post its worst sales yet this year in May is really alarming if you're sort of concerned about just how many cars this company is selling in what is a pretty significant EV market. It's the second biggest in the EU.
Craig, I mean, if this is in fact political fallout from Mr. Elon Musk, is there a plan from the company to turn things around there?
I think the fact that Musk is stepping back from the Trump administration, at least to some degree, there is a lot of optimism that could help matters. I think the other sort of side of that argument may be to sort of take Musk and Trump and J.D. Vance at their words when they say that he's not really actually leaving, right? And do we sort of think that he's actually going to step back from U.S. politics in a meaningful way? Do we think he's going to sort of change his tune with respect to European politics, where he continues to sort of insert himself into say Germany or the UK? I think he's been less specific about French politics, although he did crack a joke at the president's expense last week when he was asked about what happened with his black eye, right? And so those sorts of slights probably don't go over well with consumers in these markets. And there are other sort of more serious criticisms that he's leveled about, say, U.S. funding of European defense that I think, rub a lot of people the wrong way in various countries across Europe.
Well, I got to say, though, if I take a look at the chart, it was really February of 2024 where sales had a big decline, and Musk was like nowhere in the picture in relation to U.S. politics.
Yeah, no, and I do think that it's important to note that Tesla's sales tend to be very up and down per the chart in our story today, where toward the beginning of each quarter they tend to fall off from the end of the last month of each quarter, and so it's important not to read too much into like the month-to-month moves for this company. But what you see in our chart today is that this is a downward trend, that even when you saw, a recovery in March, the last month of the first quarter, that recovery was to levels that were far below, where you see the company tend to snap back to in the end of, quarters throughout last year or in 2023.
All right, Craig, thanks so much for joining us. Appreciate it. As always, Craig Trudell, Bloomberg Global Autos editor, talking a little about Tesla continuing to have some issues in Europe, which Mr. Musk has acknowledged in the past. Let's talk entrepreneurship. Is it a tough time to be an entrepreneur these days or not? Mike Lazaro, Cass Lazaro, authors of Shoveling Bleep, that's the FCC version, Shoveling Bleep, a love story about the entrepreneur's messy path to success. Cass, Mike, thanks so much for joining us here. Cass, how easy, how tough is it to be an entrepreneur today, to raise capital, to get ideas to the marketplace? How is it? How's the environment today?
I think it's the best time to be an entrepreneur.
Really?
Now is the time. There are so many different tools out there. There's, no-code platforms that an entrepreneur can easily use and launch their company with the least number of employees. So now is the time.
First of all, why did you guys decide to write the book? So what was the goal behind it? We obviously think the title's pretty awesome. Mike, why? Yeah. Tell us the story behind it.
Well, we wrote the book because we've done over 100 investments in early stage companies. We've started 8 companies, and we found ourselves saying the same things over and over again. It's how do you pick a co-founder? How do you greenlight ideas? How do you build a cult-like culture that people just love? And so how do you pivot when things don't go your way? And the timing was good. We're empty nesters this fall, and we said, let's put it down.
Thank you.
Let's put it down. You made it. In a book. And so what it is our love story to entrepreneurs, and really the 50 cheat codes we wish we knew when we first started out.
Cass, what's the fundraising market like today? If I go to Sand Hill Road in Silicon Valley, or I go to Austin, Texas, where all out of the smart money is, presumably.
Yeah.
Is the money available?
It's tough market right now. Okay. Money is definitely tight. So we always tell our entrepreneurs that the best way to raise money is to make money, get customers, right? The companies that are going to succeed right now, they're going to be the ones who can actually have a business model that makes money right away.
What do you think is the biggest misconception, Cass, that we have right now in the entrepreneur? So I'm like a 25-year-old kid and I want to get into this business.
It's glory. It's all glory. I can work whatever hours I want. I'll travel all around the world. Oh yeah, and that there's shortcuts.
They legit think this.
Yes.
Okay.
Literally.
Well, social media has done that. You open up social media and you have guys who are driving Lamborghinis but living in their parents' basement, and so there's this glorification of the hustle culture. We have been a 30-year overnight success story, so we have gotten to work. We've shoveled every day, and it's about working smart but working hard. And there's virtue in that hard work, which we wanted to, create an ode to in our book.
So what are some of the businesses that have crossed your guys' desks in the last year, 2, 3 that have kind of got your attention?
Ooh, that's a good one.
Yeah, so we invest in all types of stuff. Okay. Liquid Death, we were the first investor in.
Really?
Which is a water company.
That was a weird one, because I'm sitting there at the supermarket looking at this and what is it? Is it booze? Is it?
I think that's exactly the point.
Yes.
That's exactly the point.
It's a wellness product that's marketed like something that's bad for you, right? And we look at the size of the market when we invest, and I've never seen a huge company created in a tiny market. You look at the water market, and it's huge. It's a building block of life. And the founder is incredible, the best marketer we've ever met, who worked for our good friend Gary Vaynerchuk. And, we knew him. And so that's on one side. The other side is we're looking at a lot of AI stuff. And one of the most exciting companies that came across our desk is a company called Etched, which has a chip that's 10 times faster than NVIDIA's fastest chip, but only does one thing, language models. Started by 3 Harvard dropouts who are also Thiel fellows, and just raised its public at a $1.5 billion valuation. it's still way too expensive compute. And a big part of that is the silicon, the chips that power it. And they're on a mission to make it, to democratize compute for the world's developers.
How long does one have to shovel bleep until it gets a little easier?
I would say forever. Like literally, this is all, the game of entrepreneurship is about reps, right? So there's no shortcuts. There's ways to avoid stepping in it, but this is about reps. So Mike and I have, done this for the last 30 years. We've started 8 companies, and it's the same. We might have, experience in doing things a little bit faster, but just even promoting our book, like this is 24/7.
How concerned should we be about the government maybe potentially restricting funding for universities and just new stuff, R&D and that kind of stuff? I mean, is that a concern to people like you who maybe feed off of that or support that?
Yeah, I mean, I think we're in a time of massive uncertainty, and uncertainty breeds fear, and fear breeds doubt, right? Yeah. And we're talking to a lot of nonprofits, universities. I'm involved with the Medill School of Journalism on the board.
Awesome. Yep.
And you look at, pulling back funding for mission critical stuff, and you have people who are doing their life's work who all of a sudden show up and the money's gone. And this is not just for the humanities, this is for military, this is for curing cancer, this is for medical. And so it's the uncertainty of where is the next dollar gonna come from, which if you're in a lab, we want people in labs to continue working in labs. Yep. We don't want them raising money. And so once you kind of pull the funding, it's a difficult life for people who want to change the world.
Which makes stuff like what you guys do all the more important, because you need someone to step in and do that. What a pleasure. Thank you so much, you guys.
Thanks for having
Cass
us.
and Mike Lazaro joining us, authors of Shoveling Bleep, a story about the entrepreneur's messy path to success. The book comes out tomorrow, and we are looking forward to that. Are you impressed we got through this whole segment while saying Shoveling Bleep?
Yeah, we did.
Because I am.
Exactly.
Our producer was very scared, so I want to think we should get some props for this one.
Exactly.
Thanks, guys. Okay.
Also, co-founders of golf.com, which is where I spend a ton of time.
Do you really?
Crazy. Why? All right.
Hard break. We gotta go. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major averages all lower right now. That weak manufacturing report that we got at the top of the hour, as well as renewed trade tensions and geopolitical uncertainties, they're all part of the mix this morning for investors. You have energy producers and big tech, that's climbing right now. U.S. Steel and aluminum shares, they're surging as President Trump's pledge to double levies on the metals. That takes hold with investors. Steel Dynamics right now, one of the best performers in the S&P 500 in terms of index points. That's up 11.2%. And then you have Nucor, that's up 11%. Newmont Corporation, those shares right now 5% higher. Lolly Akinar, meantime, at eToro says this is a time for investors to be much more selective.
Those sectors that are insulated from tariffs are going to perform well in 2025, and these are mainly services sectors. So think about, say, financials and healthcare companies. And goods sectors are not going to be insulated, so we're staying away from that.
Right now, the S&P 500, 15 points lower. That's down 0.25%, 58.96 on the index. The Dow Jones Industrial Average is down 208 points. NASDAQ 100, 6 points lower right now. And Campbell Soup, the organic sales, returning to growth last quarter. So apparently, cheap consumers like me, or I would say lazy
Manhattan
consumers.
clam chowders to die for. I was raised on that.
I'm more of a progressive
I don't understand. Like, you put it in there, and then you have to add water. I feel that just is weird for me.
It's
I
awesome.
don't know.
I was raised on Campbell Soup.
Well, we all were, but, you know, why don't you just inject the soap? But to be fair, like, Progresso also, their sodium's like bananas.
Yep.
All those soups are.
They also make goldfish, Campbell's.
Oh, well, you know,
explains
Paul keeps them in business, yeah.
Favorite every afternoon right here. So anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg and Soup Update.
Yes, and Soup Update. I like how you did that. John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. You can also go on your smart TV, Roku TV, all that kind of stuff, and go to search Bloomberg Originals, and that's where you'll find the video feed here. The last time we saw Sam Fazeli, who's the Director of Research, and does some of the healthcare stuff for Bloomberg Intelligence. He was here in New York, and he was on his way to Chicago to some conference where a lot of these healthcare folks get together and they talk about new drugs and new therapies. And he said, watch out, there's going to be some deals coming out of that. Boy, was he right. Sanofi buying immunology biotech Blueprint for $9.1 billion. Bristol to pay BioNTech up to $11 billion for a cancer deal. Moderna is getting some new news, so we got to get Sam here. He's still in Chicago. He's at our Chicago office there. Sam, thanks so much for joining us here. We've had some deals today in the healthcare space. Help us think about this Sanofi deal here. $9.1 billion. That seems pretty substantial.
Yeah, well, it's more than I have in the back of my sofa, if you like, and you know the little change that you find there. But the sector needs these. I mean, we've had a drought of deals since Johnson & Johnson did intracellular therapeutics. And then we've got this deal now, and the sectors, as I'm sure you've talked about, and we've talked about, has been under pressure because of all the new issues that are being created for them with the current administration, and that really slowed down deal making. So it's nice to see this deal happen. Not the biggest premium in the world, $27 billion, but still it's nice to see some of these deals happen. And I think assuming we don't get another round of tariffs for pharma drugs and most favored nation conversations turning up, it might be the beginning of a little renaissance in deal making.
What was the absolute coolest thing that you learned over the weekend? I mean, I was floored yesterday. I was sitting and thinking of you and reading like all these amazing articles coming out about these amazing new drugs that could have tremendous effect on cancer, for example. What was the coolest thing you heard?
Yeah, so Alex, there's been some continued evolution and increase in opportunities in breast cancer. So AstraZeneca had 2 presentations yesterday at what they call plenary sessions, and that's one of the key areas where, I mean, the room gets packed with 10,000 people or whatever the number is. And so they had an update on a breast cancer drug which is continuing to further expand the options that patients, when it gets approved, if it gets approved, patients have in treating that disease, which has become something that a lot of people, as long as they're lucky and don't get the worst kind of it, can live with for quite a long time now. And then we had one also from them on gastric disease, gastroesophageal junction disease, which is not one of the, it's a bad one, and there's not been many therapies there. So that was a really good, very good data set, I have to say, practice changing. And there's a whole host of phase 1, phase 2 early stage drugs that look really good. So I'm going to be coming to this conference for I don't know how many more years, because it's going to keep developing.
Bristol paying BioNTech up to $11.1 billion for a cancer deal. What's going on there?
Yeah, up to is the operative word here. The actual guaranteed cash is about $3.5 billion. So about $1.5 billion right up front. And then when the deal closes, and then by 2028, another $2 billion that's not contingent on any, they're just anniversary payments. So that's pretty good, given that they acquired the asset amongst a whole host of other stuff from a Chinese biotech company acquisition, Biotheus, only a few months ago. And it's in a new class of drugs that people have got excited about. There's Merck that did a deal. There's Summit and Akeso. Pfizer just did a deal last week, paying $1.2 billion for a drug in development, which we quite like the data for that was presented here. So these are drugs that are trying to push the barrier of what we've been able to achieve with what's called immunotherapy. Can you do better? Can you push more patients to survive longer using these drugs?
What about, oh wow, I just lost my train of thought. Oh, it was there, it was so brilliant, and then it went away. Oh, I know,
Moderna.
Funding, here's my brilliant point. Government funding for universities that have big medical units. Like, what were people saying about that?
Yeah, they're not happy. I've talked to a lot of people here, and even my interestingly, an Uber driver that I had who doubles up. She works in a lab that does genomic analysis for scientists at Northwestern University here in Chicago. She said she's noticing a palpable slowdown in the requests she's getting to do analysis of laboratory analyses because people are uncertain. It's even got to my Uber driver, which is sad. No, it is a problem. People are worried, and we'll have to see whether philanthropists can fill the gap.
Sam, so from your conference there in Chicago, is the key focus still cancer, or is there other parts of healthcare that are getting as much, I guess, attention?
Yeah, but so this is a cancer conference.
Okay.
This is the biggest cancer conference in the world. People come from, and I have to say there's a palpable increase in the number of presentations by Chinese scientists and companies. Yeah, every year it's got more and more, which is expected. They've been funding research significantly for the past 15, 20 years, and this is the fruits of it. The next conference that's coming up is also, I don't think it's in Chicago, but it's over here somewhere in the US, is the American Diabetes. That's where you get all the obesity, liver disease kind of data that we're also looking forward to.
All right, Sam, thanks so much for joining us. As always, Sam Fazeli, Director of Research for Global Industries and Senior Pharmaceuticals Analyst for Bloomberg Intelligence. He's based in London, but he's in our Chicago bureau today because he spent the weekend at as he was just mentioning, a cancer conference, and where a lot of the latest science is presented. So, and then for investors, it's really important to think about how which things, which I guess therapies and drugs you want to finance and support.
I mean, does Sam not have the coolest job? Like, media is really cool.
If you're
we all
one of
love
those
it.
people,
Energy is really cool. We all love it. But
Yep.
like his stuff, like changes the world.
It does. And he actually understands the science and can explain it to people like us, which is helpful.
Which is fantastic.
Yep.
We love that. All right. Well, speaking of energy, because that's kind of my thing, talk about changing the world. Coming up next, we're going to speak to the CEO of TADE Technologies. TADE Technologies is a nuclear fusion power company, and they're trying to commercialize that. And that could be huge. It would be...
Tokamak reactor?
What?
Hike?
What kind of design is the reactor?
I don't know. I don't know. What are you doing to me? You're asking me questions. Anyway, fusion energy company developing the cleanest, safest approach to commercial fusion power. Today, that company announced that it raised more than $150 million in its last fundraising round. We're going to break that down right after this. So really looking forward to that. Talk about changing the world. All right, taking a look at the market here. The S&P is pretty much flat, just down 0.2%.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. This is Bloomberg Intelligence. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover everything you need to know in business, economics, and finance, a lot of media, and also a lot of energy. So I don't know that much about fusion power. I'm the first one to say it. John Tucker apparently knows a lot about it, but we're going to discuss this right now. It could be a really good source of clean fuel. And for this, we bring in Tate Technologies CEO, Michael Binderbauer. The company Tate Technologies just closed $150 million in its latest funding round. The whole point of this company is to develop a commercial fusion power. Michael, if I knew nothing about fusion, which is highly likely, tell me what it is, how hard it is to do.
Yeah, so it's basically what nature does best, right? It gives us our life and energy here on the planet from the sun. So any star you look up is a fusion reactor, basically, right? So what we're trying to do is to replicate that terrestrially to make essentially copious power, carbon-free, clean, and sustainable for the future of humanity.
Where are you in the process at Tay?
So we're very close. We're just one machine away to get to a point where we actually harvest more energy than what we're putting into the facility. This has been obviously a long journey. It's hard to do terrestrially. The stars have a lot of gravity. We don't have that. We have to use other means, magnets and all sorts of things. And as you've probably seen over the last few years, there's been a plethora of news inching really, really close to the goal line across multiple efforts on the planet. So we're about a 3-year way to get to net energy, and somewhere early 2030s, we hopefully have a power plant online.
What would be, if you were able to achieve it and have a power plant, like, what is that? Is that just tremendous amount of energy with like no footprint?
Yeah, it's very small footprint, so it's the highest energy density fuel you can have, about factor of 5 to 10 higher than fission even. It utilizes hydrogen or light species that are ubiquitous, so there's infinite fuel supply, if you will, and you would harvest clean energy out of that at probably starting at a scale of a gas-fired turbine, so something like 400 or 500 megawatts per plant, and it would literally be able to distribute wherever you needed it in the grid.
Can you talk about the economics surrounding this technology? Who would be the users, the buyers, the developers of this technology?
Yeah, so I think what we're seeing, and this gets to what we just announced today, aside from raising capital, we really have a long partnership with Google.
Okay.
And they've been deep with us on machine learning and tools to help make this more efficient and more economic. And in fact, they would be a great first off-taker for that, right? All the hyperscalers, everybody that has high energy intense applications growing at tremendous rates, right? With a gap between supply and demand developing, is looking for electrons, and particularly green electrons. So those would be probably the first off-takers for this technology.
Oh, I gotta ask.
Oh,
yeah. What sets you
apart? This is John Tucker. He likes his fusion.
What sets you apart from ITAR in terms of the reactor itself, the containment? That's a tokamak fusion reactor, or what?
Yeah, so good question. So ITER and others are working on tokamaks. We actually are not. We're working what you see, if you have a visual. And we have a compact machine about the size of a gas turbine that can make about the same output as those other plants. It's much more efficient, uses smaller magnets. There's various tricks in the physics that allow you to do that. And that brings something that's more compact, cheaper to produce, of course, more economic to deploy, easier to maintain, et cetera. And you can essentially centralize these. We think we can build those sort of cookie cutter in a factory and deploy on site. And the other thing I should add is that siting on this, compared to the other nuclear cousin, which is fission, right, is a lot easier. There's no meltdown possibility. There's no sort of nuclear accident of substance that people would have to worry about. It's truly clean and benign. And so you can deploy it where you need it in a much more straightforward way.
And there's no use of beryllium in that reactor?
No. In fact, ours is using hydrogen and boron, both of which are light and super ubiquitous.
Well, deuterium as the fuel, right?
So deuterium and tritium is one fuel cycle. That's used by some of us in the fusion community, and we can burn that too, but we're really focused on hydrogen and boron ultimately. That turns out that only makes helium. So you have no neutrons, you have no radioactivity to speak of. It is just a nirvana of energy, essentially. You get ubiquitous fuel in, no radioactivity or pollution in the process, totally sustainable. And we think it will be competitive from a cost perspective. It'll be probably starting out midfield in current generation asset costs. So you're not as cheap as, gas or renewables, but you're not as expensive as fission is today, is somewhere in the midfield, and then trending down.
Okay, let's pretend that neither of us understood what any of you guys were talking about in terms of beryllium. That's why we have him, right? He knows a lot about a lot of different things. Before we let you go, just how hard is it to have gotten to where you are? Like, what has been like the biggest hurdle?
Oh gosh, it's been an enormous journey. I mean, I've aged. I started this out of high school. I almost said I started out of graduate school with my brilliant PhD mentor, and then it took us about 20 plus years to amalgamate the technology around it. There's a lot of esoteric, absolutely extreme things you got to master: power supplies, accelerator technology, diagnostics, feedback loops. Use a lot of machine learning and AI. A lot of that we developed together with Google in the last decade. That can react on the blink of an eye to make changes in what happens inside, and do that reliably and consistently. And so those are all the technologies we now have. So now we're putting in the last machine. So it's been a long journey and developing lots of technology to do that.
All right, Michael, thank you so much for joining us. Michael Bindenbauer, CEO of Tay Technologies, joining us there with some exciting new technology on the energy front that John Tucker's all into, which was very fascinating.
That was like insanely impressive.
The questions were like,
yeah, but nobody understood them.
No,
so
but it was
it's
good.
like,
We love
just
it.
like
We love it.
You
make
can
it
explain to
all
me in
up.
the commercial break. That's true.
Exactly. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio. I understand that. Sirius XM Channel 121, access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio is on Sirius XM Channel 121, presented by Oracle. Stay tuned for the latest market news and industry research right now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Happy Monday, everybody. Alex Steele here alongside Paul Sweeney and John Tucker. We had a great hour of Bloomberg Intelligence. We talked fusion. We talked drugs.
Yep.
We talked entrepreneurship. We talked a lot of stuff, and we're going to continue that conversation right now. Ben Sills is managing editor for the European Economy and Government about the latest in Russia and Ukraine. Nathan Dean will be joining us from D.C. From Bloomberg Intelligence on what to expect out of policy. And then Shana Sissel, president and CEO of Banner Capital Markets, will be joining us. We're also going to get some commerce solutions data out of Visref. So this is like real-time data on the consumer, not necessarily backward looking, and then we'll kind of end taking a look at airlines with George Ferguson of Bloomberg Intelligence. But let's kick it all off right now with the Bloomberg Business Flash with John Tucker.
All right, coming off the best May for the S&P 500, about 35 years. Today, so far, we are lower. The S&P 500 down 5 points, down about 0.1%, above 5,900, 5,905 on the index right now. The Dow Jones Industrial Average down 147 points. That's a decline about 0.4%. NASDAQ 100 right now with technology in the lead. That is pushing higher, up just about 0.1%, up 18 points right now. Some of the standouts this morning in the S&P 500 in terms of index points, the metals company of Nucor, that is up 10%. Steel Dynamics up another 10%. Newmont Corporation up 5%. And Freeport-McMoRan, those shares right now 4% higher. Steel, aluminum shares surging. President Trump's pledge to double tariffs on the metals. The dollar starting the week down, right now down about, this dollar DXY down about 0.6%. Morgan Stanley joining a chorus of other voices predicting a slide down to levels last seen during the pandemic. Meantime, Russ Kostrich at BlackRock sees a backdrop for investors that's really not all that bad.
The economy is still, as of now, fairly resilient. Second, while tariffs are going to impact prices in the near term, and we probably haven't felt the full effect yet, at least we're going into the situation with inflation coming down, getting closer to Fed's target, so that's a good thing. And finally, earnings were surprisingly good in Q1.
Right now, the long bond 30-year yield, that is up 3 basis points, 496. The 10 up 3 at 443. 2-year yield up a basis points, that is at 390. Here's one for you. Hemp-derived THC beverages now being sold legally in liquor stores and online across the country. This new psychoactive drinks category is how they refer to it, competing with craft beer for precious shelf space. THC drinks are often lower in calories and sugar than alcoholic ones and generally don't produce hangovers, which is starting to play in today's wellness trends among the younger set.
Wellness trend, let's put hemp in your drink.
Well, yeah, that's what they say. Yes, you will get high from these things, so that's the latest out there. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney, along with Alex Steele, and we're joined by Bloomberg's Isabel Lee. Isabel, what are you looking at?
I'm looking at Bristol Myers buying BioNTech as much as $11 billion to license a next-generation cancer drug. So we're looking at BioNTech or BioNTech. I've heard it pronounced both those times. BioNTech, exactly, me too, but I heard some of the anchors say BioNTech. Anyway, it's higher by 20%. That is the most since May 2020 and the highest since April 24, 2025. The stock is BNTX. So this is big because competition in the area of oncology that really seeks to harness immune system to attack tumors has been intensifying. We have Bloomberg Intelligence estimating that global sales could hit $60 billion a year by 2027. So that is really a huge market. So BioNTech will receive $1.5 billion upfront and $2 billion in installments through 2028. And the company is also eligible for around $7 billion in milestone payments. So we have Bristol Myers also edging slightly higher, but definitely not as much as BioNTech.
All right, also taking a look at Boeing getting an upgrade today.
Getting an upgrade, but shares are just edging higher by 0.6%, so we're not seeing the pop that investors are probably hoping for. But we have Bank of America upgrading the stock to buy from neutral, so the ticker is BA. So the analyst there, Ronald Epstein, says that the company's aircraft emerged as a favorite trade tool for the Trump administration in recent deals. So this includes the one with Qatar Airways. So Epstein raised the price target to a street high of $260. That's up from $185. So this implies around a 25% increase from where the stock is right now.
Nucor, steel.
Steel. So this is Alex areas of expertise. We have shares in U.S. steel and aluminum stocks really rallying. And it's interesting to see U.S. steel stocks rise in the U.S., but those in Asia, Australia, and Canada sliding. We saw that during the market close. I mean, obviously, I think, and really a lot of moving parts in this deal. We have Trump saying that steel and aluminum tariffs will be up to 50% from 25%, so that's double. And he announced this in a U.S. steel plant in Pittsburgh on Friday, and he said this will help protect American workers. We have BMO Capital upgrading Nucor to outperform and downgrading Canada's Algoma Steel. So that's really, I think, a pair trade or a duo we're going to see for some time.
And then the thing is, you're going to have steel prices in the U.S. have to increase enough to make the imports viable because the imports are going to be so much more expensive. And we import more than we produce. Like net, there's on rough numbers from 2024. I mean, real rough, like back in the envelope calculations, let's say 6 million net tons. I mean, that's not nothing.
Yeah, and will that affect demand? I don't know.
Oh, yeah, there's going to be demand destruction for sure. Anyway, clearly, definitely something to watch. Will there be carve-outs? Definitely the question. All right, thanks so much, Isabel Lee, joining us. For more conversations just like this one, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, and anywhere that you listen. Now, we talked a lot about oil prices and the rally there. We were talking about short covering be a part of it. The other issue is still the geopolitical backdrop, and for that, we go to Russia and Ukraine talks. Ben Sills, a Bloomberg managing editor for European economy and government, joins us now. Are there going to be actual talks after what happened over the weekend?
Well, we have had contact between the two sides today in Istanbul. The outcome of those is still to become clear, but they have actually been talking. We know that much. It is it is difficult to see much real progress being made in this track, though. You know, as you say, not just because of the Ukrainian attack yesterday, which has caused so much attention, but also because of the large and kind of increasing number of Russian strikes on Ukraine, and particularly on civilian targets, which really are driving home the sense that Putin's not in a position really where he's interested in serious efforts to end the fighting.
Ben, it seems like the U.S. is less engaged in being a part of these negotiations. What is the role of the U.S. at this point? Can you tell?
It does, you're right. I think that the role of the U.S. at this stage is kind of semi-absent superpower. I think that the need to manage Donald Trump's emotional state is quite an important consideration for both the Russians and the Ukrainians. We know that U.S. military aid is a crucial part of Ukraine's ability to defend itself, particularly in the short term. The Europeans are trying to ramp up their own supplies into Ukraine, but they can't do it immediately, so they need to keep Trump on side for the time being. And you know, Putin, for his part, wants to try and do the opposite. So the question of how long the U.S. stays engaged is really important, even though, as you rightly point out, Trump is no longer really trying to drive forward the diplomatic track.
Who has the leverage now, Russia or Ukraine?
That's a good question. I think that in many ways Russia is in the stronger position for all sorts of reasons. Not least, its country, its infrastructure, its population has not been under these brutal attacks for the past 3 years to anywhere near the same extent as the Ukrainians. The Ukrainians are kind of reliant on the Europeans getting their act together over the next few months, and if the Europeans don't come through with both military aid for Ukraine and also more defense spending on their own militaries, more industrial consolidation, more supply chains to produce the weaponry that they need, then Ukraine is going to be in an increasingly weaker position.
All right, Ben, thanks so much for joining us. Really appreciate it. Ben Sills, Managing Editor for European Economy and Government over there at Bloomberg News, joining us from Madrid on again, off again talks. I mean, this morning I read the article on Bloomberg News, Russia and Ukraine restart talks after Kiev hits bombers. I've just finished reading that story. I looked up, there's a red headline going across saying, nope, talks over after an hour. So yeah, I don't know where we're going on that front. All right, let's get down to Washington, D.C. Not that things are any more clear there. Nathan Dean joins us, Bloomberg Intelligence Senior Policy Analyst. Nathan, your friends in Congress, they got some work to do here. Let's talk about the tax bill. The House passed something. Now the Senate has it. Where are we on this?
Yeah, so the Senate came back after 1 week, and now we're going to enter what's called the bird bath. I mean, this is actually based off of it's based off of a senator, not the actual bird. But what they're trying to do here is they're trying to figure out what passes via the reconciliation process and what doesn't. So real quickly, under reconciliation, you can essentially only do things that impact the budget. And there's a lot of provisions in any reconciliation package that doesn't. So you have to go to the Senate parliamentarian, somebody who's been in their position, that's not elected, it's just, named. And both the Republicans and the Democrats are going to have to go to that individual and say, does this provision pass what's known as the bird rule? That's called the bird bath. Now, from the investment point of view, I think the most important thing is this Senate Republican strategy of assuming the cost of extending the Trump-era tax cuts, which would be around $3.8 trillion, is effectively zero because it's current policy. If the Senate parliamentarian agrees, then we think we could see a bill that increases the deficit. If the Senate parliamentarian doesn't agree, then all bets are off. And this has to go back to the drawing board in terms of, how are you going to pay for all these, of this bill that's going to cost north of $5 trillion?
Right, and that's what makes the tariff stuff a little bit more confusing, because if you take away some of the tariffs to some extent, then you lose that revenue. So it just makes that a little muddier also.
Absolutely. I mean, you know, the tariffs were never part of the reconciliation process. They're not in the record. They're always like this something that's this shiny something in the back of the Republicans' mind saying that, look, we can actually agree to actually increase the deficit because we know the tariffs are back there. But now they're not. And so this idea here is that if you have a bill and the Senate parliamentarian doesn't agree, you have to pay for $5 trillion worth of tax extensions. Economic growth will get you a couple of trillion. And obviously we're talking about almost $1 trillion worth of cuts to Medicaid, the Inflation Reduction Act, and SNAP benefits. Those are within doubt. But eventually the Republicans are going to have to agree. Are you going to pass a bill that increases the deficit, or are you going to pass the bill that's going to significantly cut aid or, you know, things like the Inflation Reduction Act to constituencies the Republicans have already said that they don't want to do? Now, we think that this ultimately will go towards a deficit-inducing matter. So for those of you on the bond side or for the fixed income side, you know, this is something when this is passed, probably in the July timeframe, you could see a package that ultimately increases the deficit by several $1 trillion.
Is there any political cost to increasing the deficit?
No, not really, because what I would say is that it's easy to borrow today for pain tomorrow than it is to have a vote where you're going to see that pain fairly soon. You know, when Medicaid work requirements kick in at the end of next year, which is under the House plan, or if you have a bill that's going to gut the Inflation Reduction Act and you're Senator Tom Tillis in North Carolina and you've got re-election next year, if you've got plants being built in North Carolina with jobs, it's going to be very difficult for you to say, I'm going to vote to gut the IRA or I'm going to vote to cut Medicaid when that constituency is going to be harmed very soon. It's much easier to say, you know what, we'll borrow today for tomorrow's pain.
What else do you think will be market moving agenda at this point? So to some extent, it feels like the market's a little more immune to tariffs than they were. Like on an individual sector basis, sure, just take a look at steel stocks today. But as we've learned in the whole taco trade, right, Trump actually chickens out. Is that Trump actually chickens out? Trump eventually always chickens out. I feel like the reaction function to the market as a whole may be changing. If that's the case, what would change that? What would be the big mover?
Well, I would just call out that I think in the tariff front, the semiconductor and the pharmaceutical industry are somewhat exposed at the moment because, you know, the Trump ruling or the court rulings from last week essentially said President Trump can't use IEEPA to move forward with these tariffs. Now, there are other avenues, Section 301, Section 232, and that requires investigations. And we know that there are investigations going on in pharmaceutical and semiconductors. Now, it was always anticipated that these tariffs would be out in May, but the idea of sectoral tariffs somewhat allows, you know, President Trump to continue to implement this. And even though for the idea of the taco trade, sectoral tariffs is something that actually has moved forward, both under the Trump administration and the Biden administration. So I would say that if you're an investor in one of those two sectors, you got to start paying attention because these investigations are going to conclude at a certain point, and then President Trump will have the authority to say, let's go ahead and implement these tariffs. We'll see what happens.
Hey, Nathan, when do folks down in D.C. start thinking about 2026 election cycle?
Well, I think some of them have already started thinking about it, but generally from
they started yesterday.
Yeah, exactly. But what I would say is that once the Republicans pass this one big beautiful bill, call it July, there's really not much else left on the calendar. At the end of the year, in September, we're going to have a government funding fight that could potentially lead to a shutdown. But our general rule of thumb is anything by April of next year, most Congress, all 435 members of the House and 1/3 of the Senate, are essentially saying, look, I'm out this year. I'm going to be paying attention. Because you don't really have serious debates in election years because, remember, for all 435 members of the House, they don't want to be here. Their opponent is out back in their home district campaigning against them. So usually in the election that, say, 9 months before the election, nobody wants to be here in Washington. They want to be out somewhere else. And as a result, things really slow down on the legislative front and they speed up on the regulatory front.
Oh, man. All right.
It's amazing how our system works at all. You know, you think about it. The more I learn about it from Nathan, I'm like, it's amazing stuff anything gets done.
But you can also see, I mean, that's part of what Elon Musk said, too, that, I mean, take it with a grain of salt, but he was like, it's just harder to get things done, like a very disillusioned former head of Doge. All right, Nathan, thanks a lot. We really appreciate it. And Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, joining us on all the political news, or lack thereof, of the day. All right, coming up, you're looking at markets doing a whole lot of nothing, but Shana Sizzle is President and CEO of Bannerman Capital Markets. She'll join us next to talk about it.
A 3% rise in WTI is short covering?
That's what I'm saying, yeah.
All right.
I mean, because you had the geopolitical risk factor before this weekend anyway, and the big risk event was OPEC Plus. They increased production, as everyone kind of thought, 411,000 barrels of oil a day.
What does this mean
from
with the
that
Wawa?
perspective, there's no issue. You'll be fine. Just relax. It'll be fine.
When is your story going to be airing?
Ooh, Friday.
Friday. And this is a story about the relationship between crude oil and gas at the pump.
Oh, exactly.
So
tune in Friday. Thank you, Wall Street Week.
Yep.
Look at my promoter over here. Yeah. Look at that. All right. Yeah. And anyway, it's going to be fine for you, John Tucker. Don't even worry about it. We're also going to talk about spending data. What are people spending on and how much right now? This is Bloomberg.